Please like, share, and subscribe. Wishing you happiness and good luck every day.
Warren Buffett. When you hear that name, you think investing, right? But today, we're not talking about how he picks stocks. Nope. We're going to uncover the lesser-known side of his genius, the core management principles that have built one of the most enduring companies in the world. And it's all distilled from his legendary letters to shareholders. You know, the book we're drawing from today makes this really important point right from the start. This isn't about market speculation or chasing quick wins. It's a blueprint for running a business with integrity, with character, and with a vision that spans generations. It's about building something that's truly meant to last. Buffett's whole philosophy is, in his own words, simple, old, and few. We've distilled it down into these 5 core principles that really form his management manifesto. So let's dive in with the absolute foundation, the way he sees his relationship with his shareholders. Okay, this first principle, this partnership attitude, it sounds simple, but you have to understand it's a radical departure from how so many companies operate. This isn't some corporate slogan to put on a poster. It's a decision-making framework that completely redefines the relationship between a company's leadership and its owners. This quote, man, it just gets right to the heart of it. Buffett doesn't see Berkshire Hathaway as some faceless corporation. He sees it as a partnership. He and Charlie Munger aren't corporate overlords, they are simply the managing partners. And their primary job? To safeguard and grow the capital that's been entrusted to them by the real owners, the shareholders. And this slide really illustrates the stark choice every leader has. On one side, you have a partner, a co-venturer, whose fortunes rise and fall right alongside yours. On the other side, you have a patsy, a faceless member of the crowd who's just there to be manipulated. Buffett has this open contempt for leaders who treat their investors like that, urging them to buy while they're secretly dumping their own shares.
You see, this partnership mindset, it's the soil from which a lasting culture can actually grow. Once you see your company as a collective of partners, you can build something truly powerful and, well, unconventional. And for Buffett, that culture starts with one critical element, finding the right people.
And there it is. That's the key hiring filter for Buffett, a deep passion for the business itself. He calls it occupational fervor. He wants managers who get a genuine thrill from their industry, not just from the numbers on a spreadsheet. And maybe the greatest example of this in his entire career is the legendary Rose Blumkin.
This was the motto of Rose Blumkin, or Mrs. B as everyone knew her. And it was the entire foundation of her business. Sell cheap and tell the truth. It's so simple, right? But it's this incredibly powerful philosophy that embodies customer trust and long-term value. And it's exactly what caught Buffett's eye. I mean, her story is it's the American dream in its purest form. Just imagine, fleeing persecution in Russia, arriving in a new country, you can't even speak the language. It took her 16 years of hard work just to scrape together $500. And with that tiny sum, she started a business that would become the largest home furnishing store in the entire country, right there in Omaha. Her passion was so deep, she kept working until she was 103 years old.
This famous quote from Buffett, it tells you everything you need to know. His admiration wasn't just about her financial success. It was about the raw, unstoppable competitive force that is occupational fervor. I mean, how do you compete with someone like that? As Buffett realized, you don't. You join them. Okay, so the next pillar you need to maintain that true partnership is a commitment to radical, brutally honest communication. Forget the corporate jargon and all the legalese. Buffett's approach is disarmingly simple. And this is the mental trick he uses to achieve that simplicity. It's such a powerful image. When he sits down to write his famous annual report, he's not picturing Wall Street analysts. He's picturing his sisters, Doris and Bertie. They're smart, sure, but they aren't financial experts, and they've entrusted a huge part of their net worth to him. He's writing to them.
And when you're writing for your family, this 3-step process just naturally follows. It's all about full disclosure. The good, the bad, all of it. The guiding principle is so simple. Just provide the information you would want if your positions were reversed. The annual report stops being a sales document and becomes what it always should have been, an owner's manual.
Now, this is what makes these principles feel so human and so real. Buffett is incredibly open about his own fallibility. He doesn't try to hide his blunders. He puts them right out there, front and center, for everyone to learn from.
It's the natural question to ask, isn't it? Does the world's greatest investor actually make mistakes? Well, Buffett's answer is a loud and clear yes. And he doesn't just admit it quietly. He devotes entire sections of his shareholder letters to cataloging them.
with titles like Mistakes of the First 25 Years or The Mistake du Jour.
And here's the key distinction he makes. The goal isn't to agonize over errors or beat yourself up. That's a mistake in itself. The real goal is to create a culture where mistakes are treated as valuable learning opportunities, not secrets to be swept under the rug. That public analysis of what went wrong is what he believes is absolutely essential for getting things right in the long run. So this brings us to the final principle, the one that ties all the others together, a relentless, almost fanatical focus on the long game. This means actively ignoring the noise of quarterly earnings reports and the daily craziness of the market.
So instead of obsessing over meeting some arbitrary quarterly target, the entire focus at Berkshire is on these 4 enduring goals. And notice how simple they are. Stay financially stable, widen your competitive advantage, find new ways to make money, and take care of your great managers. That's the whole game plan, year in and year out.
This idea of widening the moat is absolutely central to his thinking. A moat is that sustainable competitive advantage that protects a business from invaders. The goal isn't just to have a moat, the goal is to spend every single day making it wider and deeper.
And this quote, this is the ultimate directive he gives his managers. It's such a powerful thought experiment. Just think about it for a second. How would your daily decisions change if you knew you owned 100% of the business, it was your family's only asset, and you were forbidden from selling it for at least 100 years? It instantly forces you to filter for what creates true, lasting value. So at the end of the day, whether you're running a global company, managing a small team, or just building your own career, these principles are a timeless guide. They challenge all of us to lift our eyes beyond the next quarter or the next promotion, and instead to focus on the legacy we're creating. Buffett built his moat. So the question for you is, what are you building?
When you think of a shareholder, what really comes to mind? For a lot of us, it's just a ticker symbol on a screen, right? A number that goes up and down. Well, Warren Buffett has a completely different idea, and honestly, it's the idea that has defined his entire legendary career. He sees shareholders not as speculators, but as actual, real partners. So today, we're going to unpack this incredibly powerful philosophy.
All right, so here's how we're going to break it down. First, we'll get into the core partnership philosophy itself. Then, we'll talk about what it really means to have an owner's mindset. After that, we'll look at the idea of a shared fortune, and finally, we'll wrap up with the promise of fairness that holds this whole thing together.
Okay, let's dive right into the heart of it. You have to understand, this isn't just some nice-sounding mission statement they hang on the wall. No, this is the literal operating system for every single decision made at Berkshire Hathaway. It's this radical, almost revolutionary idea that a giant corporation can be run with the soul of a small partnership.
I mean, just listen to the language he's using here. This isn't just friendly business advice, it's practically a moral demand. The word stewardship, that implies a deep, sacred duty. And partners, not patsies? Wow, that is a direct shot at the way so many companies treat their shareholders, like they're suckers. He's saying it's time to stop talking and start doing.
And here's the key distinction, the big idea. He says shareholders are the owner partners. Why? Because they're the ones who put up the capital, the actual money. He and his team, they're the managing partners, the ones entrusted to run the business for the owners. You see how that simple reframing just flips the whole script? It's not a top-down hierarchy anymore. It becomes a collaboration.
Now this is a massive shift in thinking. We all tend to see a company, like Apple or Google, as this single giant thing that owns all its factories and patents. But Buffett's view is, nope, that's not it at all. The corporation is just a conduit, a legal pipeline. The real owners of all that stuff are the shareholders. The company is just the structure that holds their assets. It's a really profound change in perspective.
Okay, so if you're an owner or partner, what does that actually mean for you? How should you think about your investment? This is where the philosophy gets super practical and, frankly, demands a whole new mindset for most people.
And this farm analogy he uses is just brilliant. Think about it. If you owned a farm, would you sell the whole thing just because of one bad weather forecast? Of course not. You'd focus on the long-term health of the soil, the quality of your equipment, the yield of the crops year after year. That is the mindset of an owner, and it's exactly what Buffett wants from his partners.
So you can see there are these two totally different mindsets. The partner knows they own a piece of a real business, so they're focused on its long-term progress. But the trader, they think they own a piece of paper, a lottery ticket. They get nervous and sell, reacting to every little meaningless price wiggle on the screen. One is investing, and the other, let's be honest, is just gambling.
And look, this isn't just some theory he writes about in his letters. It is literally how Berkshire itself operates. When they buy a huge stake in a company like Coca-Cola, they see themselves as non-managing partners. They're not trying to run the daily operations. They trust the management to do that, while they focus on being a good long-term owner. They absolutely walk the walk.
This right here, this is the ultimate test of that owner's mindset. He's saying that if you own a really great business, the daily stock price is just, it's noise, it's static. The only time that price even matters is if it gets ridiculously cheap and gives you a chance to buy more. The real value is in the business's ability to earn money over years and decades, not what the market thinks it's worth on any given Tuesday.
And you can actually see this in the data. The proof is in the pudding, right? The turnover of Berkshire's shares, meaning how often they're bought and sold, is just a tiny fraction of what you see in other big companies. This tells you that shareholders aren't just trading a stock. They're buying into a partnership for the long haul. All right, so you've got the attitude, you've got the mindset, but what's the real glue that binds this partnership together? Well, it's the explicit, ironclad promise that everyone's financial interests are perfectly, and I mean perfectly, aligned.
Now, this is so important to understand. He's not guaranteeing you'll make money. No one can do that. What he is guaranteeing is alignment. And that word he uses, lockstep, that says it all. It means management only gets rich if the owner partners do. Their fortunes are completely, totally intertwined.
And it gets even more specific. This is all about exact proportionality. There are no special stock options or giant bonuses for the top brass that aren't available to everyone else. If the company's value goes up by 10%, everybody's wealth tied to the company goes up by 10%. Simple, direct, and incredibly fair. I mean, seriously, how many CEOs do you hear talking like this, admitting they'll do dumb things and then promising to share in the financial pain? This is just radical accountability. And it builds an incredible amount of trust because you know, as a shareholder, that if they mess up, they're feeling the exact same sting that you are. So this is basically the deal. The partnership pact in action. No outrageous salaries or options, no inside track or special treatment for management. And here's the kicker. Their own personal fortunes remain overwhelmingly invested in Berkshire shares right alongside you. They have serious skin in the game. When you put all these promises together, what does it all boil down to? One thing, trust. It's the deep-seated confidence that your partners have your best interests at heart, simply because your interests are one and the same. This bond of trust is the absolute bedrock of the entire philosophy. Okay, so let's get to the final piece of this puzzle. It's the ethical framework that holds everything else up, a simple but incredibly powerful promise of fairness. Now, this sounds so simple, so obvious, doesn't it? But you have to realize, in the corporate world, this is a revolutionary idea. When you truly believe that the company's money isn't the company's, it's the owner's money, it forces a deep sense of discipline. You stop wasting it on dumb acquisitions or lavish perks, and you stay laser-focused on creating real long-term value. So what does fairness actually mean in this context? It's pretty specific. It means making sure the stock's market price accurately reflects the company's true underlying worth, what they call its intrinsic value. Why is this so crucial? Because if the price is way too high, new partners are overpaying, and if it's way too low, partners who are leaving get shortchanged. Fairness is all about the price reflecting reality. So how do they make that happen? How do you create this fairness? It really comes down to clear and brutally honest communication. Buffett sees management's job as not just running the business well, but also explaining its performance transparently, the good, the bad, and the ugly. This helps the market and all the partners understand the company's true value, which leads to a fair price for everyone. And that brings us right back full circle, doesn't it? This quote is the ultimate promise. It's the summary of partnership, alignment, and trust. It is the bond that has defined Berkshire Hathaway for decades, and it's the one promise that Buffett says will never, ever be broken. So as we wrap up, let me just leave you with this one question to think about. What if every company actually adopted this philosophy? What if every single CEO truly, deeply believed that the money in the company's bank account was really their partner's money? How would that one simple shift in perspective completely transform the world of business as we know it? That right there is the power of thinking like a partner.
You know, when most people think about Berkshire Hathaway, their minds immediately jump to Warren Buffett and his almost magical ability to pick winning stocks. But the real story, the secret sauce behind its staggering success, isn't just about the investments. It's about a deeply ingrained, almost radical corporate culture. Today, we're going to pull back the curtain and see exactly how that culture became Berkshire's ultimate competitive advantage. So here's how we're going to break it down. First, we'll get into their core philosophy, this idea of culture over controls. Then, we'll step into the shoes of a founder facing the seller's dilemma, which leads them to a choice between two kinds of buyers. From there, we'll see what Berkshire offers instead, a permanent home, and we'll even look at an incredibly honest letter from Warren himself. And finally, we'll see how this whole thing is truly built to last. All right, let's dive right in. Section 1, culture over controls. Look, this isn't some generic mission statement they hang on a wall. This is the actual DNA of the company. It's the operating system that guides every single decision they make, from the tiny headquarters in Omaha to the hundreds of thousands of people working in their companies all over the world. And Charlie Munger, as usual, just nails it. He says, look, what we do isn't complicated. It just seems that way because it's so, well, different. It's not normal. The Berkshire way isn't some complex algorithm. It's just old-fashioned common sense. But, in a corporate world that's obsessed with quarterly earnings and endless bureaucracy, that kind of simple common sense can feel downright revolutionary. And this right here, this is the bedrock. This is the single most important rule in the entire Berkshire universe. Buffett famously tells his managers to use the front page test. Basically, before you do anything, ask yourself, would you be okay with your actions being described in detail on the front page of your local newspaper? It's such a simple and yet incredibly powerful way to think about ethics. And that gets us to the heart of the matter. Buffett's entire bet is that if you get the culture right, if you fill the company with people you can trust, you don't need a 1,000-page rulebook. A strong culture polices itself. It's way more effective than an army of lawyers and compliance officers could ever be. And that's what allows for real simplicity and genuine trust. Okay, so this high-level philosophy sounds great in theory, but how does it actually play out in the real world? Well, in this next section, we're going to look at it from a really specific point of view. Of founders. Imagine for a second you've poured your entire life, your heart and soul into building a business, and now you have to decide who to sell it to. That is the seller's dilemma. And I mean, really think about that. For a founder, this isn't just a financial transaction. It's probably the most emotional, high-stakes decision of their entire life. There are no do-overs, and you're under all this pressure from your family, your employees, from brokers who just want to get their commission. The stakes just could not be higher. Now, listen to the language Buffett uses here. He doesn't call it an asset or a company. He calls it a business masterpiece. That one word completely reframes the whole situation. This isn't just about cashing out. It's about finding the right home, maybe even the right museum for your life's work, a place that's going to cherish it and protect its legacy. And this whole masterpiece idea is so important because it forces a founder to think differently about who they sell to. According to Buffett, this leads to a really clear fork in the road. In his world, as we'll see here, there are really only two kinds of buyers. And wow, this slide just lays it all out. It's night and day, right? Over on the left, you've got the financial maneuverer. To them, your masterpiece is just merchandise. Before the ink is even dry, they're already planning their exit strategy. They'll load it up at debt, dress it up, and flip it for a quick buck. But then you look at Berkshire. They see a masterpiece, they buy it forever, they hate debt, and they're looking for honest books and a loyal team. It is a completely different worldview. Buffett does not pull any punches when it comes to the term private equity. He calls it Orwellian, which basically means the name is a total lie. It implies the exact opposite of what they actually do. These firms, which used to just be called LBO operators, don't add equity. They pile on so much debt that they completely strip the equity out, often risking the company's entire future in the process. So, if Berkshire is not a financial maneuverer, then what is it? What's the alternative they're offering? Well, in this section, we're going to look at their unique promise to provide the permanent home for that business masterpiece. And the Berkshire promise is actually pretty simple. It boils down to these four things you see right here. Number one, we do what we say we're going to do. Our record speaks for itself. 2, you get to keep running your business the way you want to with incredible autonomy. 3, we buy to keep, period. There are no exit strategies. And 4, we're going to keep your business financially strong. We are not going to risk it by loading it up with debt. It's a simple but incredibly powerful promise of respect and stability. And this quote just brings that masterpiece analogy full circle. When you sell to Berkshire, you know exactly what museum your painting is going into. It's going to be proudly hung on the wall for everyone to admire. It's not going to get flipped to some other collector or just get stuck in the basement and forgotten. So how does Berkshire actually communicate all of this? Well, in this next section, we're going to look at one of their most powerful and, frankly, most unusual tools, a disarmingly direct and honest letter that comes straight from Warren Buffett himself. Let's break down what's in this thing. This letter is just a masterclass in tackling a seller's biggest fears, one by one. Buffett promises you'll run things your way. He says Berkshire will adapt to your methods, not the other way around. And then he shows this incredible confidence. He tells people to check his references, especially with the owners whose businesses have struggled after selling. And he makes it perfectly clear. We want you to stay. We don't have some MBA waiting in the wings to take your job. Every single line is designed to build trust. And then there's this. This might be my favorite part. 5 minutes. Forget months of back and forth and endless due diligence. Buffett promises a quick answer, usually in 5 minutes, on whether they're interested. It's a huge sign of respect for the seller's time, and it shows they know exactly what they're looking for. But out of everything in their pitch, this line might be the most powerful and counterintuitive of them all. Buffett is just brutally honest. He says, look, selling to us is not going to make you richer. You're just changing the form of your wealth, from a business into cash. I mean, it's such a disarming thing to say. It totally short-circuits the whole sales process and just establishes incredible credibility. Okay, so this all sounds fantastic while Buffett and Munger are running the show. But let's be honest, that raises the big question. Can this culture actually survive without them? In our final section, we're going to explore how Berkshire is literally designed to be built to last. The secret to its durability, its staying power, is that the culture isn't just a top-down thing. It's a completely self-reinforcing ecosystem. The board members are massive shareholders themselves. The managers of all the different businesses, they chose to sell to Berkshire specifically for this culture. And the shareholders are famous for thinking in terms of decades, not quarters. Every single piece of the system is aligned around the same long-term vision. And this is Buffett's own take on it. He's not just being optimistic here, he is deeply confident. He truly believes that because the culture is so embedded at every single level, it has a better chance of staying intact for decades to come than any other company he knows. And of course, he seals that confidence with a classic Buffett line, a perfect mix of a joke and a deadly serious threat. It's his personal guarantee, and maybe even a supernatural one. It's funny, but it's also a clear warning to any future leader who might even think about messing with his life's work. And that really leaves us with this final question to think about. In a business world that is just obsessed with the next quarter, with immediate results, Berkshire Hathaway stands out as this incredible counterexample. It's proof that by prioritizing things like reputation and trust and permanence, you can build something of truly massive, lasting value. It really makes you stop and think. In our rush for now, what is the true cost of building things that aren't meant to last?
All right, welcome to The Explainer. Today, we're diving straight into the mind of Warren Buffett, and specifically, his no-nonsense philosophy on what makes a corporate board actually work. You know, we're going to cut right through all that corporate speak to get to the core ideas he uses to make sure shareholders, the real owners, are protected from, well, mismanagement and greed.
So let's start with this classic Buffett quote. I mean, he doesn't pull any punches, does he? The point here is crystal clear. A board's job isn't just to sit around and advise. No, their job is to protect the owners of the company. And this single, forceful idea that directors have to slap the hands of greedy managers, that really sets the stage for everything we're going to talk about today. Okay, so here's how we're going to break it all down. First, we'll look at the board's core duty. Then, what really makes a good director. After that, we'll take a peek at the Berkshire way of doing things, and then figure out why even good boards sometimes fail. We'll wrap up with some key questions for auditors, and finally, look at the shareholders' true power. Let's jump in. All right, part 1, the boardroom's core duty. So, let's get right to it. What is the fundamental job of a corporate board? Look, it's not about networking, it's not about collecting a fancy title. It boils down to one simple, powerful word: stewardship. Directors are there to represent the real owners, the shareholders.
And stewardship means having some really tough responsibilities. I mean, it's their job to get rid of a mediocre CEO, even if everyone loves the guy. Buffett has this hilarious but kind of perfect analogy for it. He says a director's loyalty has to be to the company, not the leader. It's like this story he tells about the young bride of an 85-year-old multimillionaire. Someone asks her, "Would you still love him if he lost all his money?" And she says, "Of course. I would miss him, but I would still love him." You get the point.
But this whole idea of stewardship kind of got lost in the shuffle during the big market bubble back in the late 90s. As stock prices just went through the roof, Buffett points out that, well, the behavior of managers went right down the drain. As he put it, the CEOs who still decided to travel the high road, they didn't run into a lot of traffic.
And to really paint a picture of what was happening, Buffett borrows this fantastic line from Mae West. He says that so many CEOs, these are otherwise decent people, right? They just got completely swept up in the craziness. They started fudging the numbers, giving themselves just obscene pay packages. He says they were Snow White, but they drifted. What a perfect way to put it.
So you'd think the board of directors would be the ones to step in and stop all this drifting, right? Which brings us to part 2, and a really crucial question. What actually makes a director good at their job? Is it just about ticking a box that says independent?
Okay, so how do you find the right people for the board? Well, the standard way is this sort of legalistic checklist for independence. Are they an employee? No. Check. Do they have business ties? No. Check. But Buffett basically just throws that whole checklist in the trash. He says true independence is a mindset, and he boils it down to 3 simple tests. 1, are they business savvy? 2, are they really shareholder-oriented? And 3, are they genuinely interested in the company? And look, of those 3, there's one that is absolutely non-negotiable: business savvy. Buffett is super blunt about this. He says without real business sense, you could take a smart, admired person off the board and replace them with a potted plant, and you wouldn't lose a thing. Why? Because if they don't get the business, they can't really challenge anything. They'll just sit there quietly.
So, that's the theory. But what does it look like in the real world? Well, for that, let's look at part 3, the Berkshire Way. This isn't just stuff Buffett talks about, it's how he actually runs his own company, Berkshire Hathaway. He calls his model owner capitalism, and it is built from the ground up to make sure his directors think like owners.
Check out this number. It really tells you everything you need to know. At Berkshire Hathaway, every single director and their family owns at least $4 million worth of the company's stock. Now, that is not a token amount. That is serious skin in the game, a massive personal financial stake in how the business does.
And this simple question really gets to the heart of the psychology. Whoever washes a rental car? I mean, nobody, right? Because you don't own it. When you own something, you care for it. When you're just renting, not so much. By making sure his directors are real owners, Buffett guarantees they're going to care about the long-term health of the company.
And this whole owner mentality is just baked right into the DNA of the Berkshire board. First off, all the directors bought their stock on the open market, just like you and me. No freebies, no special deals. Second, their director fees are tiny, so they're not there for the paycheck. And this last one is huge. The company has 0 liability insurance for its directors. If things go south, they are personally on the hook.
So what does all that add up to? It's a perfect alignment of interests. I mean, their financial fate is tied directly, and I mean directly, to the fate of every other shareholder. When you win, they win big. And when you lose, they lose big. It's really the ultimate way to make sure they're thinking and acting in your best interest. Okay, so if aligning interest is so powerful, why do we still see so many boards fail? I'm talking about boards staffed with smart, decent, often wealthy people. Why do they still fail so miserably at protecting shareholders? That's what we're digging into in part 4. So this is the exact question Buffett himself asks, and his answer? It's got nothing to do with laws or regulations. He says the problem isn't the rule book. The problem is the boardroom atmosphere. It's all about human nature. I mean, just think about the social dynamics for a second. Put yourself in that room. You're sitting there with a dozen other really successful, really polite people. Who wants to be the skunk at the garden party, right? Who's going to be the one to challenge the CEO's big new project? Or even worse, suggest that the guy who invited you to this exclusive club in the first place should be fired. It is socially excruciating. And that's exactly why being friendly and collegial so often wins out over true, tough independence. And this pressure, it's never more intense than when the topic of CEO pay comes up. Buffett says that even when a compensation package is just completely over the top, for a director to suggest that the committee should maybe reconsider it, well, he says it would be like belching at the dinner table. A huge, massive social foul. So, okay, if these social pressures are such a big problem,
How does a board ever cut through all that and get to the actual truth? Well, this brings us to part 5, where Buffett gives us a really practical toolkit, and it all starts with the audit committee.
Now, here's a really critical distinction. The audit committee's main job isn't actually to do the audit themselves. Their job is to get the professional auditors to tell them everything they know, or even just what they suspect might be going on. The goal is simple, really. You have to make the auditors more afraid of misleading the board than they are of offending the CEO.
And to do that, Buffett lays out these 4 simple but incredibly powerful questions for the audit committee to ask the auditors. You see, these questions, they force the auditor to stop just passively signing off on things. They have to actively endorse the company's books. They have to go on record saying, yes, this is how we would do it ourselves. Yes, all the important information is here. And no, there are no accounting games being played.
Okay, which brings us to our final piece of the puzzle, part 6. Because it's not just about the directors and the auditors. What about the role of the owners themselves? What is the shareholders' true power in all of this?
Well, Buffett argues that a lot of big shareholders, the institutional guys, they waste a ton of energy on the small stuff, just ticking boxes on trivial governance issues. He says they should focus all of their power on just 3 questions that really matter. Why these 3? Because they hit right at the heart of where a CEO's interests might be different from the owners. Is this the right person running the company? Are they overreaching on pay? And are these big acquisitions they're making actually creating value for us, the shareholders? Or are they just building a bigger empire for themselves?
And in the end, really, it all comes back to this one piece of timeless wisdom. The entire philosophy we've talked about today can pretty much be boiled down to this single idea. You have to make sure that the treasure, the financial well-being of the directors and managers, is in the exact same boat as the treasure of the shareholders. Because when you do that, that's when their hearts, and more importantly, their actions, will truly be aligned with yours.
You've probably heard of Warren Buffett's company, Berkshire Hathaway, right? It's this absolutely sprawling empire with hundreds of thousands of employees. And yet, get this, its headquarters has a staff of only about 24 people. So how on earth is that even possible? Well, in this explainer, we're going to deconstruct Buffett's seemingly paradoxical management philosophy. It's a true masterclass in how to achieve colossal success by focusing on one thing above all else: people. And this quote right here, it really gets to the heart of it all. See, for Buffett, greatness doesn't come from reinventing the wheel or some flashy, complex new strategy. Nope. It comes from finding leaders who are absolute masters of the ordinary things. His incredible success isn't just about spotting undervalued assets. It's about identifying the right kind of leadership that can deliver these extraordinary results, all through a philosophy that's built on trust and a whole lot of passion. And that really presents a fascinating puzzle, doesn't it? How can a massive, sprawling company with all those employees be run from an office that's smaller than most startups? How does this whole empire thrive with such a famously hands-off approach from the very top? Well, the answer lies in 6 core principles. We're going to walk through the Berkshire paradox, then look at his method for finding the fanatics. After that, we'll see why he only works with winners and his philosophy of letting the artist paint. And finally, we'll talk about the power of applause and admiration, and then tie it all together with the Buffett test. So, let's start with the paradox at the heart of it all. Okay, so let's dive right in. What exactly is this Berkshire paradox? Well, it's this strange, almost unbelievable contradiction. A massive company that somehow feels and acts like a small one. And the genius behind it is, you'll see, surprisingly simple. At its very core, Buffett's philosophy is almost shockingly simple. Only work with people you genuinely like and admire. He's got this brilliant analogy for the alternative. He says that working with people who churn your stomach is like marrying for money. It's a bad idea in any circumstance, he says, but it is absolute madness if you're already rich. And that single powerful rule is the foundation for everything else that follows. Okay, so if you're only going to work with people you admire, where do you find them? How do you even start? Well, it all comes down to who you select in the first place. See, Buffett isn't just looking for competence or a good resume. He's looking for a very specific type of leader, someone he calls a fanatic. And here it is. This is the crucial test. When Buffett is thinking about buying a business, he's not just looking at the balance sheet. He's evaluating the manager. He has to look them in the eye and decide, do they love the money or do they love the business? For Buffett, that genuine, deep-seated passion for the business itself, that is completely non-negotiable. Buffett actually has this fantastic term for it. He calls it occupational fervor. It's that deep, almost obsessive passion for your work, where the craft itself is what really drives you. And he has this perfect, really telling story to explain what he means. Now, this might sound like just a funny little story, but it's actually the perfect metaphor for the mindset Buffett is always looking for. He wants a manager who is so absorbed, so excellent in their own profession, that they see the entire world through that specific lens. For this Taylor, the Pope wasn't a global spiritual leader. He was a 44 medium. That right there is occupational fervor. Okay, let me give you a real-world example of how Buffett actually spots this trait out in the wild. During the final stages of buying a company, the manager, a guy named Jack, was running late for the big final closing meeting with Buffett's partner, the legendary Charlie Munger. So when Jack finally shows up, the reason he gives for being late, it's just so telling. He wasn't stuck in some crazy traffic jam. No, he'd been circling the block, looking for a parking meter that still had leftover time on it from whoever parked there last. Now, this wasn't about being cheap. It was a powerful signal of a much deeper mindset about value, about waste, and about efficiency. And for Buffett, this was what he called a magic moment. You see, that one tiny, seemingly insignificant detail, it revealed everything about Jack's character and how he approached business. It was the perfect real-world signal of that occupational fervor that he's always on the lookout for. So, once you've found these fanatics, what's next? Well, the second principle is all about putting them in a winning environment. And to explain this next part, Buffett tells this absolutely fascinating story about a baseball bat boy named Eddie Bennett, and it's a total masterclass in strategy. So this guy, Eddie Bennett, he seemed to have the golden touch. I mean, just look at this track record. Wherever he went, championships just seemed to follow. He was with the White Sox for their World Series run, then he hops over to the Dodgers for their league win. But his biggest success, that came when he joined the New York Yankees in 1921, right at the beginning of their dynasty. So you gotta ask, was Eddie Bennett just the world's greatest bat boy? Well, maybe, but that's not really the point, is it? His incredible success wasn't about how he carried the bats. It was about who he chose to carry them for. In 1927, his World Series share, $700 for just 4 days of work, was what other bat boys were making in an entire year. His secret was simple: association. And that is the lesson right there. Eddie Bennett understood that if you associate with the best, you dramatically increase your own chances of success. Buffett applies this idea directly to his business. He sees his job as finding the business world's version of Babe Ruth and Lou Gehrig, and then just handing them the bat. So you found the fanatics. You've built a team of winners. What's the next step? Well, for Buffett, it's the most important one. And honestly, for most leaders, it's the hardest. You do nothing. You just let the artists paint. This quote just captures his hands-off philosophy perfectly. The way he sees it, Berkshire's single biggest contribution is to simply not interfere with its stars. I mean, you don't go out and hire a world-class talent like Jack Nicklaus and then start giving him tips on his swing. You provide the resources they need, and you get out of the way. This comparison really shows you just how radically different Buffett's whole approach is from the typical corporate owner. Instead of second-guessing every decision, he offers complete support, telling his managers, "I'm 100% with you, win or tie." It's not about process and bureaucracy. It's about freedom, results, and giving these proven leaders your absolute and complete trust. Okay, so this philosophy of trust and autonomy, it builds a really unique culture. I mean, think about it for a second. A lot of Berkshire's managers are already independently wealthy. They're not motivated by a bigger paycheck. So what keeps them going year after year? Well, they're driven by something else entirely. What these proven artists of business really truly want are the things that money just can't buy. They want to be treated fairly, to know they won't be taken advantage of. They want the freedom to, in Buffett's words, paint their own painting. And, crucially, they want to receive genuine applause and admiration. Berkshire is structured to provide these exact psychological rewards, the very things that big, bureaucratic companies so often strip away. And here's the real kicker. Here's why that admiration is so powerful. It's not just some generic corporate praise from HR. It comes from Warren Buffett himself, a deeply knowledgeable observer who truly gets their business, inside and out. That kind of informed expert applause, well, it's priceless, and it's a huge reason why managers stay with Berkshire for decades. All right, this brings us to our final takeaway, and it really frames this entire philosophy as a kind of test, a challenge, really. for anyone in a position of leadership, whether you're running a multinational corporation or just a small team. Buffett often gives credit for this powerful idea to the advertising genius David Ogilvy. And ultimately, his entire system really hinges on this one simple question for any leader. Do you have the confidence, the lack of ego, to surround yourself with people who are better and bigger than you are? Because your answer to that question determines whether you build a company of giants or a company of dwarfs. That right there is the essence of the Buffett way.
All right, let's get into it. We're going to unpack how Warren Buffett thinks about one of the most important and, let's be honest, most abused parts of business: communication. We're not just talking about what to say, but really how you say it, and why he's so convinced that total, brutal honesty is the real foundation of any great company. So this whole explainer, it doesn't kick off with some crazy financial formula. Nope, it starts with this simple, really personal image. Because this right here, this is the key to understanding Warren Buffett's entire philosophy. See, he's not writing for Wall Street analysts. He's not trying to impress financial journalists. He's writing for his sisters, Doris and Bertie. And you've got to understand, they're smart, they own a huge piece of the business, but they're not financial wizards. And that one single idea, well, it changes absolutely everything.
And this super personal approach, it creates what we can call the Dear Doris principle. I mean, think about it. It's all about cutting out the jargon, ditching the complexity and the corporate speak, and just having a direct, honest conversation with the people who actually own the company. So, what it all boils down to is this one simple but really powerful rule. You talk to your partners the way you'd want them to talk to you. I mean, it's just the golden rule, right? But for corporate finance. Imagine for a second you owned a small business with a friend. You'd expect them to tell you everything, the good, the bad, and the ugly. Of course you would. Well, Buffett's whole point is that a giant public company should be no different.
Okay, so let's see how this principle actually gets put into practice. This is where it goes from a nice idea to a strict set of rules for what corporate reporting should be, and, just as importantly, what it absolutely should not be.
And wow, the difference here is just night and day. On one side, you have the standard corporate fluff. You know what I'm talking about. Reports that have been scrubbed clean by PR departments, filled with glossy photos of factories and smiling employees, all designed to sell you a story. And then you have Buffett's way. He wants the unvarnished truth, straight from the CEO's mouth, all about the long-term health of the business. He literally expects the CEO, the person getting paid the big bucks to run the place, to talk directly to the owners. No ghostwriters, no spin doctors. He demands every important fact, especially the bad news, and this part is crucial. Everybody gets the information at the exact same time. No quiet little briefings for Wall Street insiders. It creates a level playing field for every single shareholder, big or small.
And here's the result. It's so simple, it's brilliant. If you communicate honestly, you attract long-term, trusting shareholders. But if you communicate with spin and cynicism, you attract cynical investors who only care about the next quarter's stock price. Basically, if a company treats its shareholders like intelligent partners, it'll get partners. If it treats them like idiots, well, it'll get speculators. You get who you deserve. All right, so we've seen the do's. Now let's flip the coin and look at the don'ts. These are the deceptive tricks, the financial sleight of hand that make Buffett absolutely shudder. These are the red flags that should make you think, what are they trying to hide? So first up on the list is a really common, but in Buffett's view, totally misleading metric, EBITDA. You see these letters everywhere. The idea is that it shows you a company's real operating profitability. But here's the problem. It conveniently ignores some very, very real costs of doing business, especially depreciation. You know, the cost of all your expensive machinery slowly wearing out and needing to be replaced.
And Buffett's takedown of this is just legendary. He says, look, depreciation isn't some abstract accounting concept. It is a real cash expense. It just happens over a long period of time. Those capital expenditures, the money you spent on buildings, on equipment, that was real money. To ignore that cost is, as he so perfectly puts it, like believing the tooth fairy is going to show up and pay to keep your business running. It's pure fantasy.
And he doesn't stop there. He warns about a whole bag of tricks. You've got pro forma earnings, which are basically made-up profits where you just conveniently leave out all the bad stuff. You have these massive, non-recurring charges that are supposedly a one-time thing, except they seem to happen every single year. And my absolute favorite is his description for how companies explain away huge mistakes, the concept of the virgin birth. The blunder just appeared. Nobody was responsible.
So you might be wondering, how in the world is a regular investor supposed to navigate this minefield? How do you tell the honest managers from the ones trying to pull a fast one? Well, luckily Buffett gives us a pretty clear survival guide.
He boils it all down to 3 powerful rules to protect yourself. First, watch out for signs of weak accounting. Because if they're cutting corners on the stuff you can see, just imagine what's going on with the stuff you can't. Second, if the footnotes and explanations are confusing, it's not you, it's them. It's confusing on purpose. And third, be really, really suspicious of managers who are always promising to make the numbers. Sooner or later, they might just be tempted to make up the numbers.
And the big takeaway here is this. These little signs of dishonesty, they almost always point to much bigger hidden problems. That one slightly misleading number or that one confusing footnote isn't just a small mistake. It's a huge warning sign that the entire culture of the company might be rotten.
Now, this entire philosophy, this whole way of thinking, it all comes together in one legendary event, the Berkshire Hathaway annual meeting. And this is not your typical stuffy corporate formality. Oh no, this is the living, breathing embodiment of everything we've been talking about.
Buffett himself calls the meeting a Woodstock for capitalists. Just think about that for a second. He's turning this typically boring corporate ritual into a massive festival of direct, honest communication. It's an open invitation to a totally different kind of event, one that's all about real business talk and a genuine sense of shared ownership.
So unlike most annual meetings, which are scripted, stuffy, and over in 20 minutes, this thing is a marathon. We're talking 5, sometimes 6 hours, where Buffett and his partner Charlie Munger just sit on a stage and take any question anyone throws at them. There's no PR team screening the questions. It's the ultimate display of transparency, where every single shareholder hears the exact same information at the exact same time, straight from the top.
And this commitment to total candor gets put to the test in the most amazing ways. Just look at this story about a young shareholder named Nicholas Kenner. He gets to ask the very first question, and he doesn't mess around. He hits Buffett with the single toughest question any CEO can face, and it's coming from a kid.
But it gets even better. The next year, this same kid calls Buffett out on a tiny factual error from the previous year's report about his own age. And this moment perfectly captures the entire point. He connects a tiny, seemingly innocent mistake to the much, much bigger issue of trust and accuracy in the company's official financial numbers. His question is just brilliant. If you can't get a small detail like my age right, how can we trust you with the really big numbers? That is accountability in its purest form.
And all of this leaves us with one final big question to think about. After all the number crunching, all the market analysis, is it possible that the most important lesson from one of the world's greatest investors has nothing to do with finance at all? Is it possible that the most valuable asset is actually the simple, radical power of just telling the truth?
All right, let's get into one of the wildest business stories you will probably ever hear. It's about a handshake deal worth millions, a founder who was an absolute force of nature, and how Warren Buffett ended up buying the Nebraska Furniture Mart. And trust me, this is so much more than a case study. It's a masterclass in grit, character, and just pure unstoppable will.
You know, we have to start right here. Just let this quote sink in. One of the greatest investors in history says he would prefer to physically fight a grizzly bear over competing with you in the open market. I mean, that tells you you're dealing with someone on a whole other level. And he was talking about Rose Blumkin, the one and only Mrs. B.
So, that's the big question, right? Who was this woman? How on earth did a Russian immigrant who couldn't read or write build an empire so powerful that the Oracle of Omaha himself was basically in awe of her? Well, that's the story we're going to unpack today.
To really get the legend of Mrs. B, you have to go all the way back to the beginning. Her journey didn't start in some fancy MBA program or with a big venture capital check. No, it started with a desperate escape and a dream that was funded by nothing but sheer determination.
I mean, just look at this timeline. The challenges she overcame are just staggering. At 23, she escapes Russia by convincing a border guard she was going to buy leather for them. She gets to America on what Buffett called a peanut boat, literally with a tag around her neck that just said Fort Dodge, Iowa. She knew zero English, she winds up in Omaha, and get this, she learns English from her own daughter, who'd come home from school and teach her the day's words. For 16 years, she sold used clothes, just saving every single penny she could.
And this was the number, $500. After 16 long years of scrimping and saving, of selling clothes, of bringing her family over from the old country for $50 a head,
This is what she had to show for it. In 1937, she took that $500, her entire life savings, and bet it all on her dream.
With that little bit of money, she didn't just open up a furniture store in her basement. She basically launched a retail revolution. And it was all built on a philosophy that sounds almost too simple to work, but it was devastatingly effective.
You have to understand, she wasn't walking into an easy market. The furniture business in Omaha was controlled by rich, established players who did absolutely everything they could to put her out of business. They strong-armed manufacturers to stop selling to her. They dragged her into court, accusing her of violating these so-called fair trade laws, which were really just legal price fixing to keep everyone's profits high. It got so bad at one point, she had to sell the furniture out of her own home just to pay her bills on time.
So what was her response to all of this? What was her secret weapon? It was this. Her entire business plan, her whole strategy was just sell cheap and tell the truth. While they were busy with lawyers and backroom deals, she was focused on giving her customers the best possible price. That was it. That was the whole playbook.
And this story just perfectly captures her genius. So she's in court, right, fighting one of these price-fixing cases. She not only wins the case by proving she could make a profit at her low prices, but what does she do right after the trial? She sells the judge $1,400 worth of carpet. She didn't just win the argument, she won the customer, proving her entire business model right there in the courthouse. It's absolutely brilliant.
Now, when you build a reputation like that as this completely unstoppable force in business, people start to take notice. And eventually, her biggest fan and future business partner came knocking, a guy named Warren Buffett.
So fast forward to 1983. Mrs. B is 89 years old, and Warren Buffett comes to her and writes a check for $55 million for 90% of her business. But look, it's not the dollar amount that makes the story so legendary. It's how the deal got done.
For a deal this big, Buffett's company, Berkshire Hathaway, did none of the things you're supposed to do. No armies of accountants auditing the books. Nobody went to count the inventory. They didn't even check to see if she actually owned the real estate. They asked for 0 warranties, nothing. Why? Because the entire deal rested on one thing and one thing only, their complete and total trust in Mrs. B's character.
And this quote from Buffett just says it all. A $55 million check for her word. He considered that an even trade. That's the power of integrity, right there. Her reputation, built over a lifetime of telling the truth, was worth more to him than any stack of financial reports.
So she's 89, she sells the business, she's a multimillionaire many times over. Time to hang it up, enjoy a well-deserved retirement, right? Not even close. For Mrs. B, the work was everything, and she was far from done. 2 years after selling the company, at 91 years old, she's still there 7 days a week, open to close. Her famous line was, "I come home to eat and sleep, and that's about it." Buffett tells this great story about going to her house, and she had little green price tags on her own lamps and sofas just because it made her feel like she was still at the store.
Her post-sale career is it's unbelievable. At 95, she gets into a spat with her grandsons about how to run the place, so she quits. What does she do? At 96, she opens a brand new competing furniture store literally right next door to the one she'd just sold. It became so successful, so fast, that a few years later, Buffett had to buy her out again just to stop competing with her.
And if you need one story to sum up her dedication, this is it. It's time for her 100th birthday party. But there's a problem. It was scheduled for an evening when the store was open. For her, the choice was simple. The party can wait. The customers can't. So she just rescheduled it for a night the store was closed. Unbelievable.
And you've got to love this. When Buffett bought her second store, he made sure he got a non-compete agreement this time. He later joked that he was incautious when he first bought her out at age 89, but he wasn't about to make the same mistake with her at 99. Even at nearly 100 years old, she was a competitor you simply did not want to face.
So after this incredible lifetime of building, of competing, of winning, what can we actually learn from her? Buffett says every business school in America should be studying this woman. So let's try to break down the core principles of the Mrs. B playbook.
Buffett really boiled down her family's success to these simple rules. Work your tail off, know what you're good at, and be honest about it. Once you know that, act decisively. Ignore everything else that's a distraction, and just treat everyone, from your customers to your suppliers, with respect. It's not complicated, is it? It's just fundamentals executed with passion.
And that's really the bottom line. What is the true essence of business? Buffett says you learn it from Mrs. B. It's all about taking care of your customers. Period. Give them an incredible deal. Work harder than anyone else to serve them. That's it. That's the whole game.
And this is Buffett's final verdict. Take the most powerful Ivy League educated CEOs in the world, put them in a room to compete with Mrs. B, a woman who couldn't read or write, who started with $500, and she would win. Because she understood the one thing that mattered more than anything else. She understood the customer.
So that kind of leaves us with a really interesting question for our time, doesn't it? You know, we live in this world of big data, of complex algorithms, of sophisticated strategies taught in elite universities, but is it possible? Is it just possible that the single most powerful and timeless business strategy of all is still the one a Russian emigrant figured out in her basement over 80 years ago? Sell cheap and tell the truth. Definitely something to think about.
All right, let's dive into one of the greatest investment stories you'll ever hear. We're talking about Warren Buffett's 45-year love affair with a single company, Geico. Yeah, Buffett himself actually called it a triple play. And that's exactly what it was. 3 totally different, incredibly successful bets on the same company over almost 50 years. I mean, think about that. It's a journey that starts with him as just a curious student and ends with him owning the whole darn thing. So to really get how this all happened, we're going to walk through 5 key chapters in this story. The quest for knowledge, a first business love, the million-dollar mistake, ouch, rescuing a giant, and finally, owning the economic castle. All right, let's get into it. Okay, so our story kicks off not in some fancy boardroom, but way back in 1950 at Columbia University. A young Warren Buffett enrolls, and get this, he doesn't really care about the degree. He's there for one reason and one reason only, to learn from his hero, the legendary investor Ben Graham. So as he's digging into everything he can find about his mentor, he stumbles on this little detail that would basically spark a lifelong obsession. He finds out that Graham is the chairman of this little-known company called GICO. Now for Buffett, GICO was a total unknown, in an industry he knew nothing about. But you know what? That just made him even more curious. And that curiosity, it led him on what you could only call a pilgrimage. One Saturday in January 1951, he just hops on a train to Washington, D.C. and goes straight to Geico headquarters. Of course, it's a Saturday, so the place is locked up tight, but does that stop him? No way. He literally just pounds on the door over and over until finally a custodian shows up and lets him in. So this custodian points him to the only person working that day, an executive named Lorimer Davy Davidson. And what happens next is just incredible. Davy sits down with his random college kid and spends the next 4 hours giving him a complete masterclass on the entire insurance business. And let me tell you, that single meeting would absolutely change Buffett's life forever. You see, Davy laid it all out. He explained Geico's secret weapon. They sold insurance directly to a very specific, low-risk group of people, government employees. And by doing that, they completely bypassed the super expensive agent system that all their competitors were stuck with. Now, this wasn't just a tiny little advantage. No. This was a massive, permanent cost advantage built right into their business model. It was something their rivals just couldn't copy. So after that 4-hour session, Buffett is just buzzing. He is more excited about Geico than any stock he had ever looked at. He was totally convinced he'd found something incredibly special. So what does he do? He puts his money where his mouth is. During 1951, he invests a grand total of $10,282 in Geico stock. Now, hold on. That number, $10,282, might not sound like a lot today, but you have to understand, this was not a casual little bet for him. By the end of that year, that single investment made up more than 65% of his entire net worth. I mean, he was just 20 years old, and he was basically betting the farm on this one company. The conviction is just off the charts. All right, so let's fast forward just 1 year to 1952. After all that research, all that conviction, what does he do? He sells. He commits what he himself later called an act of infidelity. He sold his entire stake in Geico because, well, another shiny stock had caught his eye. And oh boy, did that decision cost him the shares he sold for a little over 15 grand. If he had just held on, they would have been worth around $1.3 million just 2 decades later. That is a painful, painful mistake. But it probably taught him the single most important lesson of his entire career. When you find a truly wonderful company, you just don't sell it. Okay, so fast forward a whole 24 years. It's 1976, and Buffett gets a second chance. But it's not under happy circumstances. GICO, now under new management, had made some huge mistakes. They'd forgotten what made them special, strayed from their low-risk customers, and totally messed up their pricing. The company was literally on the brink of going bankrupt. But here's where Buffett's genius kicks in. He understood something crucial. The managers had messed up, sure, but the fundamental business model, that incredible cost advantage he saw back in 1951, it was still there. So, with a new, brilliant CEO named Jack Byrne coming in to clean house, Buffett's company, Berkshire Hathaway, starts buying up shares. This time, he wasn't just an investor. He was coming in as a rescuer. This long, long courtship, this on-again, off-again relationship, finally reaches its climax in 1995. After 44 years of watching, investing, and waiting, Berkshire Hathaway makes its third and final move, the one that completes the triple play. They made an offer to buy the half of the company they didn't already own for $2.3 billion. Now, that was a hefty price tag, for sure. But what it did was give Buffett and Berkshire full, permanent control of what he loves to call an economic castle. So, what on earth is an economic castle? Well, it's just a great way to think about a business. It's a company that's protected by an economic moat, some kind of durable, sustainable, competitive advantage that's so strong it's like a moat around a castle. It keeps all the competitors out and protects the profits inside. And GICO's moat? Well, it was built out of the exact same stuff that got him so excited as a kid back in 1951, only now it was wider and deeper than ever. We're talking about those rock-bottom costs that came from selling directly to customers. It was an advantage that pretty much no other competitor could ever hope to replicate. Of course, Buffett also knew that a great castle is worthless without great people running it. So he entrusted GEICO to these absolute superstars. You had Tony Nicely, who ran the insurance side of things with just incredible focus. And then you had Lou Simpson, who was a genius at managing the investments. In fact, Simpson was so good, he was seen as a potential successor to Buffett himself. But even after all of this, decades of success, billions of dollars, Buffett never ever forgot the man who started it all. He stayed friends with Davey Davidson for 45 years. He always said that 4-hour masterclass on a random Saturday was the moment that truly shaped his entire destiny. So what's the big takeaway from this whole story? It leaves us with this really powerful idea that sometimes your biggest mistakes in investing, and maybe even in life, aren't the bad things you buy, but the truly wonderful things you sell way too early. It's a powerful reminder to know when you found something special, and then to have the guts, the conviction, to just hold on.
Let's talk about a mistake, a massive $409 million mistake. Now, what makes this story so powerful is who made it, none other than Warren Buffett. We're going to dive into this using his own words from his shareholder letters to see how one single acquisition spiraled into a total nightmare. And in the process, it uncovered a danger that Buffett is convinced threatens the entire financial system. So yeah, let's get right into it.
I was dead wrong. Wow. You just don't hear an investor of Warren Buffett's stature say something like that very often, do you? But these 3 words, they kick off a heck of a story, a really tough lesson that ended up costing Berkshire Hathaway hundreds of millions of dollars, and maybe more importantly, exposed a flaw in our financial system that Buffett warns could bring the whole global economy to its knees.
Okay, so let's set the scene. The year is 1998. Berkshire Hathaway, Buffett's company, makes a deal to acquire General Reinsurance, or GenRe for short. Now, on the surface, this looked like a slam dunk. Buffett had been watching this company for decades. He thought it was this disciplined, conservative, really well-run operation. He was pretty sure he knew exactly what he was buying.
But, you guessed it, there was a catch. Lurking inside GenRe was a ticking time bomb. Buffett and his partner, the legendary Charlie Munger, they took one look and immediately spotted a part of the business they knew was, in their words, unattractive. It carried, quote, sizable risks that could not effectively be measured. The problem wasn't the boring, stable insurance business they thought they were buying. Oh no, it was something else entirely. Something way, way more dangerous.
And that ticking time bomb had a name, GenRe Securities. It was a trading operation that dealt in derivatives, and believe me, it was an absolute monster. To really get why this was so terrifying for them, we first need to understand what in the world they were actually dealing with.
So what is a derivative?
Well, to put it simply,
It's just a contract whose value depends on something happening in the future, right? It could be based on a stock price or an interest rate, or as Buffett once joked, even something as random as the number of twins born in Nebraska. The key thing to understand here is that these aren't simple, quick trades. These are long-term bets, sometimes lasting for decades, with values that swing around based on all sorts of incredibly complex variables.
And this, right here, really lays out the crucial difference. When you buy a share of stock, the deal is basically done and dusted in a couple of days. That risk that the other person won't pay up, it vanishes almost instantly. But with a derivatives contract, man, you could be tied to another company for 20, 50, maybe even 100 years. That is decades for things to go sideways, for that other company, what they call the counterparty, to go bust. This slow building risk over time, that's the whole ball game right there.
So here's a number for you, 23,218. This number, it just perfectly captures the insane scale of the problem that Berkshire Hathaway had just inherited by buying Gen Re. This wasn't a dollar amount, nope, it was something far, far more tangled. This was the number of individual outstanding derivatives contracts that were sitting on the books of Gen Re securities.
And you know what? That number, as shocking as it is, it barely even scratches the surface. Those 23,000-plus contracts were spread across 884 different counterparties. Buffett himself admitted that some of them had names he couldn't even pronounce, let alone figure out if they were financially sound. And get this, some of these deals had terms stretching out for a full century. It was just this dizzying, incomprehensible web of obligations. It was literally impossible to truly understand the mountain of risk they'd just taken on.
So Buffett and Munger, they knew what they had to do. They had to dismantle this monster. They began this absolutely massive, multi-year task of unwinding the entire portfolio, one painful contract at a time. But they were about to learn a very hard lesson. Escaping this web was a whole lot harder than getting caught in it.
Buffett's analogy here is just perfect, isn't it? Like hell, derivative trading is easy to enter but difficult to leave. I mean, that captures the entire problem right there. Signing one of these contracts is the easy part, but once you're in, you're stuck with that promise, often for decades. Sure, you can try to pass the risk on to someone else, but as Buffett found out, you almost always end up with some kind of lingering liability. You just can't walk away clean.
And this timeline, it just showed you what a grueling process this was. They started the wind down in early 2002. Almost 2 years later, they still had over 7,500 contracts to deal with. By the beginning of 2005, it was down to under 3,000. It took them nearly 5 full years of painstaking work just to wrestle this monster back into its cage. And here it is, the final bill for all that effort. $409 million. That was the total pre-tax loss that Berkshire took just to get out of this business. And what's really staggering, what's truly mind-boggling, is that this happened during what Buffett himself called a benign market, a period with no major bankruptcies or credit crises. It just makes you shudder to think what the cost would have been if things had really gone sour.
Now, this $409 million lesson wasn't just about one bad business deal for Buffett. No, for him, it was like getting a terrifying glimpse into a systemic risk lurking deep in the heart of the global financial system. His personal mistake became the foundation for a much bigger and much more dire warning to all of us.
And this right here is probably Buffett's most famous warning ever on this subject. He's not just saying derivatives are risky, he is literally comparing them to weapons of mass destruction. He sees them as these massive time bombs just sitting there, dormant for now, maybe, but with the potential to cause catastrophic, lethal damage to the entire economic system.
So, where does all this lethal danger come from? Well, a huge part of the problem is the accounting. Officially, it's called mark-to-market. But when you're talking about these super complex long-term derivatives that don't have a real-world price, Buffett calls it mark-to-myth. It basically allows companies to use, in his words, fanciful assumptions to report these huge imaginary profits today that might never actually show up. And this kind of accounting was at the heart of scandals like Enron and was a big player in the 2008 financial crisis.
The other massive danger is what he calls the daisy chain risk. See, the derivatives market concentrates enormous amounts of risk in the hands of just a few giant dealers who are all interconnected and trading with each other. This slide shows exactly how it can go wrong. A single failure can set off a cascade. Firm A fails, right? So it can't pay Firm B. Well, now Firm B has a huge hole in its books and it's in trouble, so it can't pay Firm C. Before you know it, the problem spirals out of control into a full-blown crisis across the entire system.
And this is Buffett's brilliant, if maybe a little cheeky, way of explaining that daisy chain risk.
You might think you're safe because the company you made a deal with is rock solid, but you have absolutely no idea about the risks their counterparties are taking. The web of connections is so vast and so hidden that nobody, not even the regulators, can truly see the whole picture.
So, with the business finally shut down and the big warning sent out to the world, Buffett does something pretty amazing. He turns the spotlight one last time back on himself, and he offers a final, brutally honest assessment of his own part in this whole costly mess. He flat out admits that he and Charlie Munger knew Generate Securities was a big problem from the moment they bought it. Charlie, he says, wanted to move fast and just shut it down immediately, but Buffett, he hesitated. Instead of acting decisively, he dithered. He wasted several years trying to sell the operation, an effort that he later admitted was basically a doomed endeavor from the start.
And he even puts a price tag on that dithering. He estimates that his delay, his failure to just rip the Band-Aid off right away, cost his shareholders at least $100 million. I mean, that is an incredibly frank admission of a personal failing that came with a very real and very expensive price.
After years of struggle and hundreds of millions of dollars in losses, the nightmare was finally over. And with his classic, folksy humor, Buffett uses this old country song lyric to explain just how relieved he was. The whole process was so painful that he was just glad to be done with it, no matter what it cost.
So, what are the big lessons we should take away from Buffett's $409 million mistake? Well, first, there's the danger of concentration. The risk for the entire system is held by just a handful of huge players. Second, the problem of complexity. Like we saw with Gen Re's 23,000 contracts, these things get so tangled that nobody can truly figure out the risk. Third, the threat of contagion. That daisy chain effect means one failure can ripple through the whole system. And finally, the illusion of mark-to-myth profits, which can make a company look perfectly healthy right up until the moment it suddenly collapses.
And we'll end with another one of Buffett's most famous sayings. He learned the hard way that Gen Re's Securities was, in fact, swimming naked, and his incredibly expensive and painful experience serves as a powerful lesson that is more relevant today than ever. It really leaves us all with a pretty critical question to think about. When the next financial tide goes out, who are we going to discover has been swimming naked all along?
So, how do two of the world's greatest investors actually think about risk? You know, for them, it's not about avoiding it, not at all. It's about getting paid to take it on. Today, we're going to unpack the entire risk management philosophy of Warren Buffett and Charlie Munger, using their own words. Let's dive right in. And you've got to love this quote to kick things off. It's funny, it's disarming, but it gets right to the heart of the matter. Don't take a risk, not even a tiny one, unless the reward is absolutely worth it. This simple, almost folksy idea, well, it's the foundation for everything we're about to cover. All right, so here's our game plan. We'll start with the big picture, their philosophy of risk. Then we'll get into the nitty-gritty with the 3 key rules they live by. After that, we'll look at a pretty wild case study, the super catastrophe business. Then we'll talk about why they prefer lumpy profits over smooth ones, and we'll wrap it all up with a powerful way to think about preparing for the unthinkable. Okay, first up, the core philosophy. See, the goal isn't to run away from risk. No way. The key is to understand it so deeply, so intimately, that you know the exact price you should charge for taking it on. It's not about sitting on the sidelines. It's about making sure you get paid well for playing the game. And this is where their discipline really shows. I mean, it's so tempting, right? When interest rates are low, you just want to reach for a tiny bit more income. But for them, it doesn't matter if it's U.S. Treasuries or a gigantic insurance policy. The rule is the same. You never, ever compromise on your standards for a few extra basis points. That discipline is just non-negotiable. So how does this big idea work in the real world? Well, let's look at the core principles they use in their insurance businesses, which is really a masterclass in risk management. They believe the real winners in this business are the ones who stick to 3 specific rules without fail. And here they are, the 3 pillars of their underwriting discipline. Number 1, know exactly what you're getting into. 2, make sure one single bad event can't sink the entire ship. And 3, don't do business with bad people. Now, that sounds almost too simple, doesn't it? But the genius, as always, is in the execution. Now let's dig into that first one, because what they consider discipline is fascinating. It's not just about crunching numbers. It's about having the humility to only take on risks you truly deeply understand. And that means thinking through the absolute worst-case nightmare scenarios. But here's the crucial part. You have to ignore what your competitors are doing. If they're pricing foolishly just to grab market share, you just step aside and let them have it. This is such a critical point. Okay, so you might insure against an earthquake in California and a hurricane in Florida. On the surface, they seem completely unrelated, right? But what if a massive financial crisis hits at the exact same time? Could that one event connect them both? That's the real work, constantly playing detective, looking for hidden connections that could cause one disaster to trigger another, making sure you never ever face a loss that could threaten the whole company. And this third principle, this might be the most profound one of all. You simply can't put a price on dishonesty. There's no premium high enough to make up for the headaches, the hidden costs, and the outright fraud you'll face when you're dealing with unethical people. So the rule is brutally simple. Avoid them. Completely. All right, now let's see how these principles hold up under the most extreme pressure imaginable. We're talking about the super catastrophe or super cat insurance business. This is where the stakes are as high as they get. So what in the world is this business? Well, essentially, Berkshire Hathaway sells insurance to other insurance companies. Think about it. When a truly massive disaster strikes, a Hurricane Katrina, a mega earthquake, the normal insurance companies could literally go bankrupt. So they buy policies from Berkshire to protect themselves from that nightmare scenario. Berkshire takes on the kind of volatility that almost nobody else on the planet can handle. Just let that sink in for a minute. This quote gets to the very soul of the mindset you need for this business. You don't hope a disaster won't happen. You operate with the absolute 100% certainty that it will. The entire business is built not just to survive that terrible year, but to actually come out stronger when it finally arrives. Now, to get a sense of the scale we're talking about, let's look at the past. The World Trade Center disaster was the biggest insured loss in history. It cost the industry about $35 billion. That was an event that shook the entire global insurance world to its core. But Buffett and Munger, they're thinking about something much, much bigger. In the industry, a single event that causes $100 billion in losses is often called unthinkable. It's a number so huge that most companies don't even bother planning for it. In that, right there, is the difference. That's the whole ballgame. While everyone else calls it unthinkable, at Berkshire, they call it a scenario they need to prepare for. They've already done the math. They know their share of that loss would be huge, but totally manageable. And when that day comes, their checks will clear. That is the ultimate test of their entire philosophy. So you have to wonder, how do you psychologically prepare for that kind of insane volatility? Well, this leads us to a really fascinating and totally counterintuitive idea they have about profits. You see, most of Wall Street is completely obsessed with smooth, predictable earnings. A steady 12% return, quarter after quarter, that's the holy grail. But Berkshire plays a totally different game. They would much, much rather earn a volatile, lumpy 15% on average over 10 years than a smooth 12%. They are perfectly fine with having some amazing years, followed by a year with a massive headline-making loss, as long as the long-term average is better. That takes a kind of psychological strength most managers just don't possess. And a huge reason they can embrace that lumpiness is because they're deeply skeptical of all the fancy predictive models. They believe that sense of precision you get from these complex computer models is what they call a chimera. It's an illusion. The models are great at looking at the past, but they can't predict something totally new, a real black swan event. And relying on them creates this dangerous false sense of security, which ironically makes a huge mistake more likely, not less. And this isn't just theory. Just think about so-called portfolio insurance. It was this complex, computer-driven strategy that was supposed to protect everyone, but it completely failed and made the 1987 market crash even worse. The models were the source of the disaster. It's a perfect real-world example of the dangers of putting too much faith in a flawed model. Okay, so if you can't trust the computer models, what do? How do you actually prepare for the unthinkable? This brings us to our final section, and a really powerful mental tool you can use to engineer your own survival. This is classic Charlie Munger, and honestly, it might be one of the most powerful mental models you will ever come across. It's called inversion. It's simple. Instead of trying to figure out how to be successful, you spend all your time figuring out what would guarantee failure, and then you just make sure you never ever do those things. And this is exactly how they apply inversion. They look at something they might do and ask, what is the absolute worst possible outcome? And if that outcome is something they can't tolerate, like, say, bankruptcy, they refuse to even take the first tiny step down that path, no matter how small the odds seem. That's why they avoid huge amounts of debt. It's why they structure their insurance business so that even the biggest disaster imaginable is still survivable. And what's so brilliant is how this all connects back to their most famous piece of advice. When other insurance companies get greedy and start cutting prices, Berkshire gets fearful and backs away. But after a disaster strikes, when everyone else is running for the hills, totally fearful, that's when Berkshire is ready to be greedy, writing policies at fantastic prices. It's all one single consistent mindset. And that leaves us with one last thought, and this one is for you. This framework isn't just for billionaires running global companies. We can all use inversion. Think about your career, your finances, your health. What is the one outcome, the one disaster that you absolutely cannot tolerate? What seeds of that disaster might you be planting right now without even realizing it? And what can you do, starting today, to make sure you never, ever go there? Let's talk about CEO pay. It's a topic that's always in the news, right? You see these gigantic numbers, and it's hard to make sense of it all. So today, we're going to cut through all that noise. We're going to look at executive compensation through the eyes of one of the sharpest, most rational minds in business history, Warren Buffett. And, well, Buffett doesn't exactly ease into the subject. He kicks things off by calling himself the typhoid Mary of compensation committees. What on earth does he mean by that? He means he's the guy who walks into the room and infects it with an idea that's frankly pretty unwelcome in most boardrooms: rational, owner-focused thinking. And this slide really says it all, doesn't it? Just think about this for a second. He's been a director at 20 different public companies. That is an insane amount of experience. And in all that time, only just one CEO ever actually put him on the committee that decides their pay. That little at the end, that's Buffett telling you everything you need to know. His clear-eyed, shareholder-first perspective is usually the last thing a CEO wants anywhere near their paycheck. So being that outsider, that typhoid Mary, gives him the perfect view to diagnose what he calls the great pay problem. We're going to start by breaking down his diagnosis of why the whole system for paying CEOs is just fundamentally flawed. Let's get into it. According to Buffett, setting CEO pay isn't really a negotiation. It's more like a play where everyone already knows their lines. You've got your key players here. First, the compensation committees. He calls them tail-wagging puppy dogs, just happy to approve whatever is put in front of them. Then you have the compensation consultants, a group he says isn't exactly famous for being loyal to the shareholders who are footing the bill. And the whole thing gets wrapped up in fancy boilerplate language from lawyers and HR to make it all look official. And this leads to a classic piece of Buffett wisdom, and it's aimed right at those consultants. If you can't tell whose side someone is on, they are not on yours. It's so simple, but so powerful. Think about it. The consultants are hired by the CEO and management. They know exactly who butters their bread, so their main incentive isn't to protect the owner's money, it's to come up with a pay package that makes the CEO happy so they get hired again next year. So how does all this keep pushing pay higher and higher? Well, Buffett says it all boils down to an argument that's almost hilariously childish, something we all tried as kids. But Mom, all the other kids have one. He argues that this exact same logic, just dressed up in a bunch of corporate jargon, is what drives the whole process. And that kid's argument? It actually has a fancy, official-sounding name: peer group analysis. A consultant picks a group of so-called peer companies to compare against. But here's the game. No board ever wants to say their CEO is below average, so they always aim to pay at least at the median, and usually they want to be in the top half. This creates a ratchet that can only turn one way. Every time a company pays above the old average, they create a new, higher average for everyone else to chase next year. Pay can only go up. And the result of this whole peer group game is as simple as it is inevitable. As Buffett says, yesterday's most egregious excess becomes today's baseline. That one insane headline-grabbing pay package from last year, it's not seen as an outlier to avoid. Nope. It becomes a new data point that pulls the whole average up, and it becomes the new starting line for this year's pay talks. This leads to one of the most maddening things in the whole corporate world. Buffett puts it so bluntly. In the executive suite, nothing succeeds like failure. A CEO can run a company into the ground, get fired for it, and still walk out the door with a golden parachute worth tens, sometimes hundreds of millions of dollars. It's a system where you can literally get paid more for failing than most people will earn in their entire lives. It's wild. Okay, so after laying out the disease in pretty brutal detail, Buffett, of course, offers up a cure. So now we're going to look at his radical alternative. It's a system he built at his own company, Berkshire Hathaway, based on two ideas that are shockingly rare in these discussions: simplicity and fairness. This is the Berkshire way. So does this alternative way actually work? I mean, really? Well, the results, they pretty much speak for themselves. At Berkshire Hathaway, Buffett is in charge of setting the pay for the CEOs of about 40 of their major businesses. So in all those years, how many of those top executives have voluntarily quit to go take a higher paying job somewhere else? The number is a big fat 0, not 1. That is an absolutely stunning track record. So what's the secret sauce? What's the magic formula for that incredible track record? It's not some complex algorithm. It really boils down to these 3 core principles. First, keep it simple and fair. It has to be something anyone can understand. Second, and this is absolutely crucial, you only tie incentives to the results a CEO can actually control. And third, you don't issue lottery tickets. No huge windfalls just because the stock market went up or something else happened that had nothing to do with the manager's actual performance. All right, so let's dig a little deeper into the actual mechanics of this. For Buffett, it's all about replacing the mindless corporate ritual we've been talking about with pure, simple rationality. It's about building a system that just, well, makes sense. Buffett loves to use baseball analogies, and this one is perfect for explaining that principle of control. He says, if the CEO bats .300, he gets paid for being a .300 hitter, even if the overall company has a terrible year because of a recession or something. And the reverse is also true. If he bats .150, he doesn't get a huge bonus just because some other division hit a home run. You get paid for your performance, period. And this gets to a really critical distinction. We always hear companies talk about aligning interests with shareholders, but Buffett says most plans are really a heads-I-win, tails-you-lose situation for the CEO. They get all the upside, but they have no real skin in the game on the downside. The Berkshire way is a true partnership that goes in both directions. There are carrots, for sure, but there are also sticks. Stock options are a perfect example of this flawed alignment. They sound great, right? But Buffett points out some huge problems. For one, the price of the option isn't adjusted for all the profits the company keeps and reinvests. That means a manager can make a ton of money just for treading water while the company's value grows automatically. Even worse, it actually creates an incentive for managers to not pay dividends to you, the owners, because every dollar they keep in the company makes their options more valuable. And that brings us to the one idea that completely changes the game at Berkshire. Money is not free. This sounds simple, but it is a radical concept in the corporate world. Berkshire managers are actually charged an interest rate, or real cost, for the capital they use in their business. This forces them to think like true owners. It makes them ask, is this new project really going to earn a return that's higher than what it cost us? If not, they get penalized. It forces them to be incredibly disciplined with shareholder money. So after breaking down the problem and walking through a real, rational solution, we come to the final verdict. What's Buffett's ultimate message here? And maybe more importantly, who actually has the power to fix this broken system? His conclusion is crystal clear. Real, meaningful change isn't going to come from a few new rules or from so-called independent directors. For Buffett, the only way this gets fixed is if the largest institutional shareholders, we're talking about the huge pension funds, the giant index funds, the real owners of these companies, finally stand up and demand a complete overhaul of the whole system. The power is with them. To wrap all of this up in one perfect little story, Buffett tells this great anecdote about his boyhood hero, the baseball slugger Hank Greenberg. So Greenberg's son grew up to be a sports agent, and one day he came to his dad for some negotiating advice. He was representing a player and wanted to know how much of a signing bonus he should ask for. Now, Hank Greenberg was all about pay for performance. He didn't care what other guys were making, he didn't care about potential. He just cut right through all the noise with one simple, powerful question. What did he hit last year? He wanted the results. The answer came back, .246. Now, for anybody who follows baseball, you know that is, well, it's pretty mediocre. It's not terrible, but it is definitely not the kind of performance that commands a huge payday. It's just average. And Hank Greenberg's response was immediate, and it was legendary. He just told his son, ask for a uniform. That's it. Your performance was good enough to earn you a spot on the team, to get a uniform, but that's all. The big bonus, the extraordinary payday, that has to be earned through exceptional performance, not just for showing up. In that story, it just perfectly captures Buffett's entire philosophy. It's not about being cheap, it's about being rational. It's about paying for what is actually produced. And it leaves us with one final, pretty provocative question to think about. If real, controllable performance is the true measure of value, How many of the day's incredibly complex, jargon-filled pay plans are, when you get right down to it, really just asking for a uniform? So, when you think of one of the most successful investors in history, what comes to mind? Probably a calendar that's just completely packed, right? Back-to-back meetings, nonstop calls, just a total whirlwind of activity. But what if I told you the real secret to Warren Buffett's incredible success is, well, the exact opposite? Today, we're going to dive into his totally radical and kind of unconventional approach to managing his time. Okay, let's kick things off with this quote from Buffett's legendary business partner, the one and only Charlie Munger. I mean, he just lays it all out right from the get-go. Their whole strategy, it's not about doing more stuff, it's about thinking more. And that philosophy just flies in the face of the whole hustle culture that's everywhere in business today. So this brings us to a really provocative question, doesn't it? I mean, we live in a world that just glorifies being busy. So could the real key to hitting peak performance, to building incredible wealth, actually be doing less? It sounds nuts, I know. But believe it or not, Warren Buffett's life is basically a masterclass in this exact idea. All right, so here's the game plan for this explainer. First, we're going to completely bust the myth of the busy CEO. Then, we'll get into his famous 80% reading rule. After that, we'll look at the raw power of his empty calendar and really dig into why he sees time as the only true currency. And to wrap it all up, we'll see how we might be able to apply some of these lessons to our own lives. Sound good? All right, let's jump right into part one, the myth of busyness. We're about to challenge that whole classic picture of the hyper-scheduled, always running around executive. And just listen to who's saying this. It's Bill Gates, a titan of industry in his own right. And he's just expressing pure admiration for Buffett's schedule, or I guess his total lack of one. That tells you something, right? This isn't just some weird quirk, it's a strategic choice, one that even his biggest peers are totally in awe of. And really, the contrast here is just, it's night and day. On one hand, you've got your typical C-suite exec, where their value is almost measured by how packed their schedule is. But then you've got Warren Buffett. His days are all about unstructured hours, a calendar that's wide open on purpose, and this laser focus on deep thinking. He has literally engineered his entire life to dodge that reactive busyness that just traps so many other people. So you've got to be asking, if his calendar is so empty, what in the world is he doing all day? Well, that brings us right to our next section, the 80% reading rule. And trust me, this is the engine room for his entire operation. Yeah, that number, it's just incredible. 80%. Up to 80% of his workday is spent just reading and thinking. This isn't his downtime, you guys. This is the work. While everyone else is stuck in meetings, Buffett is soaking up information, he's connecting the dots, and he's building that massive knowledge base that fuels every single one of his investment decisions. And we're not talking about light beach reads here. He's crushing 5 newspapers a day. He's digging deep into annual reports, those dense financial filings like 10Ks and 10Qs, and all sorts of magazines. The man is a learning machine, and his main tool is the written word. This is exactly how he spots opportunities that pretty much everyone else, stuck in their back-to-back meetings, completely misses. And here it is, straight from the man himself. He just lays it out so simply. The huge majority of his time is input. It's reading. The output, the actual buying and selling, that takes up a tiny fraction of his day. What does that really tell us? It tells us that the action is the result of a ton of preparation, not just constant motion. Okay, so this brings us to the how. How does a guy in his position actually pull this off? Let's get into section 3, the power of an empty calendar. We're going to see how he's deliberately engineered a life of unstructured time. So this all comes from a super famous interview with Charlie Rose. They're at Buffett's favorite steakhouse, and Rose asks him to just walk him through a typical day. And in response, Buffett pulls out his date book. He's not just going to tell him, he's going to show it. And there it is, the punchline. Charlie Rose, who's used to interviewing world leaders and CEOs with insane schedules, is just visibly shocked. The calendar of one of the richest men on the planet is almost totally blank. And Buffett's response? He just says, I just don't do it. I don't want to live that way. And he made that call a long, long time ago. And his physical space, his office, is designed to back this all up. Someone who observed him once noted that in his office, there's no stock terminal, not even a computer on his desk. He famously said, I am a computer.
The phone isn't ringing off the hook. It's a quiet sanctuary, built for one thing and one thing only: concentration.
This one interaction just sums it all up so perfectly. A family friend asks when he could stop by, and Buffett's reply wasn't, let me check my schedule. Nope, it was, come anytime. He owns his calendar. His calendar does not own him. I mean, that level of freedom and flexibility is just, it's almost unheard of at that level. So why? Why go to all this trouble to protect his time? Well, that gets us to the core philosophy. Section 4, time is the real currency. This is all about the fundamental belief system that's driving every single one of these behaviors.
This is such a cool insight from his son, Howard. He said when he was a kid, it really bugged him that his dad, this super successful guy, never did simple chores like cutting the grass or washing a car. But later, it clicked. Buffett had done the math on the opportunity cost. His time was just infinitely more valuable when he was thinking and reading than when he was doing, well, mundane stuff. He ruthlessly outsources anything that gets in the way of his real work.
And if you want to know just how much he values his personal time, get this. Buffett once said he would happily pay $5 million a year just for the ability to play online bridge for 12 hours a week. Why? Because that time brings him a ton of joy and relaxation. He thinks it's an absolute bargain that it only costs him $95. That just shows you the insane premium he puts on his own unstructured time.
And you know what? It all comes down to this one simple truth. For Warren Buffett, time isn't just a thing you manage. It is the single most valuable asset in the entire world, because it's the only one you can't buy more of. Every single decision he makes is run through that filter. Does this protect my ultimate asset?
Okay, let's pull this all together in our final section, applying the Buffett method. We're going to look at a few key takeaways from this whole philosophy of the empty calendar. Charlie Munger tells this absolutely brilliant story about a character from World War II named Captain Glotz. So a general furiously asks Captain Glotz what he does, and his super blunt response was, "Not a damn thing." And that right there kind of sets up the whole ethos of Berkshire Hathaway. And here comes a punchline. The general then turns to Glotz's right-hand man and asks what he does, and his reply, "I help Captain Glotz." Munger says that is the single best way to describe his own job at Berkshire. Their role isn't to be busy, it's to help the main thinker think. It's a hilarious story, but it's such a powerful illustration of their focus on thoughtful inaction over just mindless action. So how does Buffett actually make this happen in the real world? He boils it down to something incredibly simple. He calls it his Nancy Reagan policy. I just say no. He is absolutely ruthless about declining invitations, turning down meetings, and saying no to requests that don't line up with his most important priorities. It's a simple rule, but it's not an easy one to follow, and it's how he protects his most valuable asset. And that brings us to our final thought for today. Look, Buffett's life is obviously an extreme example, right? But the core principle is universal. It really forces us to ask ourselves, are we busy or are we productive? What meetings, what tasks, what commitments are just filling up our calendar? What could you maybe eliminate from your own schedule to create even a little bit more space to just sit and think?
Imagine this. You're handed the keys to a $9 billion company. The catch? It's just hours away from completely imploding, and it might just take the entire global financial system down with it. Well, that is exactly where Warren Buffett found himself back in the summer of 1991. We're going to break down how he navigated what was probably the single biggest challenge of his life, and in doing so, gave us all a timeless playbook for how to handle a crisis.
And you know, that is not an exaggeration. Carol Loomis from Fortune magazine, she just nailed it. This wasn't just another tough day at the office for Buffett. No, this was a deeply personal test, a high-wire act, where the survival of a legendary firm hung on one single, incredibly important day. The stakes just could not have been any higher. So how in the world did one of the most powerful firms on Wall Street end up teetering on the edge of oblivion? Well, you know how these stories often go. It all started with a few really bad decisions that were basically left to rot in the dark, and they just spiraled into a complete and total corporate nightmare.
Right, so this thing didn't just happen overnight. The seeds were planted a few years earlier. Let's wind the clock back to 1987. Buffett's company, Berkshire Hathaway, plunks down a staggering $700 million in Salomon Brothers, making them the biggest shareholder. Now fast forward to the winter of 90 and 91. You've got this star bond trader, Paul Moser, who decides to just break the law, again and again, making illegal bids to try and corner the U.S. Treasury market.
By April, the top brass, we're talking the chairman, the president, they know all about it. And what do? Nothing. Crickets. For 4 critical months, they sit on it. Then, boom, August rolls around, the story breaks, and the whole company just goes into an absolute freefall.
When you really boil it down, there were 2 huge problems here. And it's a pattern we still see today, right? First, you had the crime itself. One rogue executive doing illegal stuff. That's bad for sure, but you can probably contain it. The much, much bigger problem, the cover-up. The chairman, the president, the top lawyer, they all knew. And their decision to just bury it, to hope it would all just magically go away, that was the real disaster. Their inaction, not telling the board, not telling regulators, and not telling their biggest investor, Warren Buffett. That's what turned a small fire into a full-blown inferno that threatened to burn the whole place down.
So this complete failure of leadership, it pushed the entire company to a single point in time, right to the edge of a cliff. The whole fate of the company, and maybe even the stability of the global markets, it was all hanging by a thread. There was just one day to save it all.
And listen, these are Warren Buffett's own words. Just think about that for a second. This is a guy who has seen it all. Market crashes, recessions, you name it. He built one of the greatest companies in history, and yet he points to this one day, Sunday, August 18th, 1991, as the most important day of his entire life. That tells you everything you need to know about the kind of soul-crushing pressure he was facing.
So what happened that Sunday morning? The U.S. Treasury just dropped the hammer. They officially banned Solomon from bidding in government securities auctions. Now, for a Wall Street bond firm, that is a corporate death sentence. It's like telling Amazon they can't use the internet anymore. Their entire business model just vanished in an instant. The consequence was terrifyingly clear. Bankruptcy wasn't a possibility anymore. It was pretty much a certainty.
And just think about what was really on the line here. A $9 billion company, a pillar of the American financial system with 8,000 employees all over the world. Their jobs, their families' livelihoods, all of it was about to just disappear overnight. The whole thing was just teetering on the absolute edge of annihilation.
So with the financial world basically holding its breath and the doomsday clock ticking, Buffett steps in. He takes over as the interim chairman. And he didn't have time to mess around with some complex 100-day plan. Nope. He came in with a simple but incredibly powerful 3-step strategy that has basically become a masterclass in crisis management. So let's break down that playbook.
Okay, so here it is, the Buffett playbook. It's actually deceptively simple. Step 1, practice total, absolute contrition. No excuses, no maybes. Step 2, commit to radical transparency. Get every single skeleton out of the closet right now. And step 3, make immediate, decisive changes at the top to send a clear signal that the old way of doing things is over. Let's dig into each one.
Step 1 was all about contrition. And just look at that quote. There is no hedging, no corporate speak, none of that mistakes were made garbage. Buffett's message to regulators, to Congress, to the public was just brutally honest. We did wrong. He basically told the world, yeah, we're pleading guilty. This immediate, unconditional admission of guilt was a really painful first step, but it was absolutely essential to stop the bleeding and to even begin thinking about rebuilding trust. Step 2 was radical transparency. And for this, Buffett gives a ton of credit to his longtime partner, the moral compass of Berkshire, Charlie Munger. Munger's advice was crystal clear. Get the whole truth out and get it out now. And as Buffett admits, they had no idea what would happen. It was a huge gamble, but they threw their doors wide open to investigators, promising to cooperate completely. This act of total disclosure was all about proving that the new guys in charge were serious about cleaning house. And that leads us straight to step 3, decisive, almost ruthless change. The bond trader who started this whole mess, fired. The chairman, the president, and the top lawyer who tried to cover it up, all of them were forced to resign. And to send the most powerful signal you possibly could that a new era had dawned, who steps into the fire as the new interim chairman? Warren Buffett himself. It was a complete and total housecleaning at the very top, and it happened in just a matter of days.
All right, so with the immediate fire put out and the firm saved from going under, Buffett's next job was actually way harder. He had to rebuild a completely shattered culture and a ruined reputation. To do that, he didn't hand out a new rulebook. Instead, he introduced a simple but absolutely brilliant new ethical standard.
So this is the really crucial point. Buffett understood that you can't fix a broken culture with a bigger compliance manual. It just doesn't work. You have to fundamentally change how people think. He knew that creating an atmosphere of integrity, a place where people actually want to do the right thing, is so much more powerful than 1,000 pages of rules ever could be.
And this is the genius of how he did it. He gave all 9,000 employees what he called the front page test. He told them, look, before you do anything, to stop and think about this. Would you be okay if your actions were described in detail on the front page of your local newspaper for your spouse, your kids, your friends, and all your neighbors to read? If the answer is even a little bit no, then just don't do it. It's an incredibly simple and powerful way to make ethical decisions.
Buffett then laid out his entire plan directly to his shareholders. He showed real accountability by setting aside a massive $200 million reserve for the fines he knew were coming. But he also showed some toughness, vowing the firm wouldn't be a patsy for a bunch of frivolous lawsuits. He went right after the root cause, that irrational bonus culture that encouraged crazy risks. And he laid out a new, simple vision to run a first-class business in a first-class way.
So you're probably wondering, did all of this actually work? Well, the results were nothing short of incredible. In Fortune's very next survey of corporate reputations, Salomon, this company that had just been dragged through the mud and basically left for dead, ranked second out of over 300 companies for the most improved reputation. That is just a stunning testament to the power of Buffett's playbook.
Okay, so as we start to wrap this up, let's just distill the timeless lessons we can learn from this incredible story, drawing from the hard-won wisdom of both Warren Buffett and his partner, Charlie Munger.
First up, a crucial lesson from Charlie Munger on the danger of hubris. Look, the folks at the top of Salomon were some of the smartest people on Wall Street, but being smart didn't make them immune to the arrogance and overconfidence that led them to believe they could actually hide a major federal crime and just get away with it.
Munger's second lesson is just as important and just as direct. When you've got a big problem, you have to face it right away, head on. Sweeping it under the rug, like Solomon's leadership did, it only guarantees one thing. That problem is going to fester, it's going to grow, and eventually it will threaten your very existence.
And finally, Buffett himself brings it all home. He pinpoints the single root cause of this entire disaster, a simple, very human reluctance to face bad news. That instinct to hesitate, to just hope a problem will magically go away on its own, that's what nearly destroyed a $9 billion company and the jobs of 8,000 people. And that leaves us with one final thought. The front page test, it isn't just for Wall Street traders or big shot CEOs. It's a universal principle for integrity for all of us, in our work and in our lives. It forces us to ask a really tough question. If our actions today were printed on the front page tomorrow, what would that story say about us? What would be on your front page?
Welcome to The Explainer. Today, we are cracking open the playbook of one of the most successful companies on the planet. We're getting inside the mind of Warren Buffett to really understand the management philosophy that powers Berkshire Hathaway. And you'll see it's a system built on trust, on autonomy, and on a relentless, almost stubbornly, long-term perspective. Okay, let's just dive right in with the single most important idea. Honestly, everything else we're going to talk about is built on this one quote. This isn't just some nice-sounding mission statement, it's a mental model. It forces you to completely shift your thinking, to forget about quarterly earnings and start thinking about permanent, lasting value. Every single decision we're about to explore flows from this one powerful directive. So, to really get a handle on this, we're going to break it down into 5 key areas. We'll start with the foundational mindset itself, then look at how they spot great businesses, what they think a CEO's real job is, their pretty unique take on acquisitions, and then, finally, how it all ties together for the long run.
Right, so the crucial thing to get is that the Berkshire Way doesn't start with spreadsheets or numbers. It starts with this simple but incredibly powerful mission for its managers. It's all about creating this deep-seated sense of ownership, a feeling of permanence that guides every single action, big or small. And that mission gets translated into these 4 crystal-clear long-term goals. They're like the North Star for every decision. And just listen to the language here, Gibraltar-like, widening moats. This is all about strength, defense, and durability. It's not about being the flashiest company out there. It's about being the most resilient one, a fortress that's powered by incredible people.
Okay, so how does this philosophy actually play out in the real world? Let's get into how they use it to figure out which businesses are even worth owning in the first place. Buffett has this incredibly simple way of sorting all the companies in the world into just 3 buckets. And it all starts with this, the economic moat. I mean, it's a perfect analogy. Think of a business as a castle. Now, capitalism basically guarantees that if you have a profitable castle, everyone else is going to try to storm the walls. A moat, like a killer brand or a low-cost advantage or some unique patent. That's the big, formidable barrier that keeps the invaders out and protects your profits for years, even decades. And here's where Buffett makes it so easy to understand. He uses an analogy we can all get: 3 kinds of savings accounts. The great businesses are those rare gems that are like a magical savings account where the interest rate actually goes up over time. The good ones, they're solid, they pay an attractive rate. And then you have the gruesome. These are just capital-sucking monsters that are constantly forcing you to pour more and more money in just to stay in business. Think of the airline industry, which Buffett famously said would have made more money for capitalists if someone had just shot down Orville Wright at Kitty Hawk. And really, this one sentence just sums it all up, doesn't it? It's their entire philosophy of quality over junk. Don't get seduced by a cheap-looking business that's fundamentally flawed. It is always, always better to own even a tiny piece of a truly incredible company. Okay, so once you own a great business, it starts generating cash. A lot of cash. The next question, and this is probably the most critical one, is what do you do with all that money? Buffett believes this isn't some side task for the finance department. He thinks it is the CEO's single most important job. But how do you actually know if a CEO is doing a good job with that capital? I mean, what's the real test? The market, and a lot of media, is obsessed with one particular number. But Berkshire argues it's often totally misleading and actually encourages the wrong kind of behavior. And this slide just lays out the critical difference so clearly. Look, almost anyone can make total earnings go up just by reinvesting more capital. That's like getting more interest just because you dumped more money into your savings account. It's not genius. The real test is the rate of return you're getting on that capital. For every single dollar you put to work, how many cents of profit does it actually generate? That right there is the true measure of a manager's skill. And this way of thinking leads to this super disciplined 3-step logic for what to do with company profits. It's like a rational waterfall. First, can we reinvest this dollar inside the business and create more than $1 of real value? The bar is incredibly high. If the answer is no, then you move to step 2. Should we give it back to the shareholders, probably by buying back stock? It's all about constantly asking, what's the next best thing we could do with this dollar? Now, this disciplined approach to money extends to one of the most glamorized and often most destructive parts of the business world, acquisitions. While so many CEOs seem to love the thrill of the deal, Berkshire looks at it with, well, extreme skepticism.
I mean, Buffett's view on corporate deal-making is just hilarious. And brutally honest. He sees all these CEOs who fall in love with the idea of transforming some mediocre company, a toad, into a beautiful prince. But what usually happens? They just end up with a portfolio full of really expensive croaking toads.
And this isn't just a theory. It's backed up by real stories, like this one. When Berkshire was thinking about buying a company called Scott Fetzer, an investment bank that had failed to sell it before offered to show them their big, detailed analysis for a cool $2.5 million fee. And his partner, the legendary Charlie Munger, gave this all-time classic response. It tells you everything you need to know about how little they value the typical Wall Street sales pitch. They don't care about rosy projections or slick presentations. They trust their own analysis of the business, not some banker's sales document. So instead of having teams of M&A guys chasing down deals, what do? Their strategy is radically simple. They've built a reputation as the best home in the world for a great business, so they don't have to go hunting. The best deals actually come to them. And this, right here, is their golden rule of acquisitions. You can be the most brilliant manager in the world, a total genius, but if you're in a leaky boat, you're much better off switching boats than trying to patch holes. In the end, the underlying economics of the business will almost always win.
So how does this all come together? Let's get to our final section and look at Berkshire's really unique, hands-off management culture. This is where the philosophy becomes a daily reality for the people actually running their companies. This slide just shows the stark contrast perfectly. On one hand, you have the typical corporate headquarters.
You know the drill. Layers of bureaucracy, endless meetings, what Buffett calls ritualistic and non-productive activities. Berkshire is the complete opposite. It's a center of capital allocation that basically gets out of the way and lets its managers do what they do best, run their businesses. The entire system, the whole thing, is designed to attract and keep a very specific kind of person. These aren't just employees, they're stewards. Most of them are already rich. They don't have contracts holding them there. They work because they are genuinely passionate about their business, and Berkshire gives them the freedom to act like the true owners they are. Of course, a culture of total autonomy like that can only work on one foundation: complete trust and brutal honesty. There's just no room for hiding problems or sugarcoating things. The expectation is that managers raise issues the second they see them, because that's the only way to solve them. As Buffett says, the most important thing to do when you find yourself in a hole is to stop digging. And if you want to see what this philosophy looks like in the real world, get this. That's the approximate size of Berkshire Hathaway's entire corporate headquarters. This isn't just a quirky fact, it's the physical proof of their belief in decentralization. There are no massive layers of bureaucracy because, well, there's literally no space for them. And that brings us right back to where we started, to that core idea behind the whole philosophy. See, this isn't just about investing, it's a powerful way to think about making decisions in any part of your life. Forcing yourself to adopt that 100-year mindset makes you separate the urgent distractions from what is truly, fundamentally important for long-term strength and value. So it's a great question to ask yourself. What would you do differently? So when you put your hard-earned money into a company, you're putting your trust in its leaders, right? But what are those CEOs and executives really doing behind the scenes? Well, today, we are going to pull back the curtain on executive behavior, and we're going to do it using the sharp, no-nonsense wisdom of one of the world's greatest investors, Warren Buffett. Right off the bat, Buffett does not mince words. For him, this isn't just some small business issue. It's a full-blown crisis of trust. What he's calling for is a total shift in mindset. He says CEOs need to stop seeing their shareholders as, well, as patsies they can easily fool, and start treating them like true partners. And that's the big idea we're going to unpack today. So what does that actually look like? Well, on one side, you've got the partner model. This is where the CEO and the shareholders are basically in the same boat, rowing in the same direction. Everyone's interests are aligned for long-term success. But then you have the patsy model. And in this world, shareholders are just a means to an end, a tool to be used for the executive's own personal gain, usually through short-term stock bumps and some very creative accounting. All right, so to really get to the bottom of this, we're going to follow Buffett's critique through 6 key areas. We'll start with that core idea, partners or patsies. Then we'll get into the shocking double standard that protects bad CEOs. We're going to dive deep into the world of imaginative accounting, see how even great companies can lose their way, talk about the danger of following the herd, and wrap it all up with a fantastic analogy about Wall Street's moral compass. Okay, first up, partners or patsies. According to Buffett, the root of this entire problem really comes down to one simple question. Does the CEO think like a true owner of the business, or just like a highly paid manager who's kind of just passing through? And you know what's so interesting? It's how Buffett and his partner Charlie Munger actually live this philosophy. They keep pretty much all of their wealth, over 99%, in their own company. They've never sold a single share. This means they treat the company's money exactly like it's their own. Because, let's be real, it pretty much is their own. And that's why they get so disgusted by CEOs who are out there telling everyone to buy their company's stock while they're secretly dumping their own shares. And this little story just illustrates the point perfectly. Buffett tells this great anecdote about an executive who used to get free weekly haircuts, all paid for by the company. But the second a cost-cutting initiative meant he had to pay for them himself, bam, he immediately switched to getting a haircut just once every 3 weeks. It's funny, right? But it's a perfect example of how quickly behavior changes when it's your own wallet on the line. Now, this whole owner versus manager thing, it leads directly to what Buffett calls the supreme irony of business management. The fact that the person at the very top of the food chain is often the least accountable person in the entire organization. Just look at this table. It breaks it down so clearly. Think about a typist, right? They're hired to type 80 words per minute. If they can only manage 50, they're gone. The standard is concrete, it's measurable, and if you fail, there are consequences. But for a CEO, the standards are often super fuzzy, or they don't even exist. And that means a bad leader can be carried indefinitely. So why on earth does this happen? Well, first, like we said, the standards are just fuzzy. Buffett has this incredible line. He says, "The boss shoots the arrow of managerial performance and then hastily paints the bullseye around the spot where it lands." Classic. Second, there's no direct boss looking over the CEO's shoulder every day. And finally, the people who are supposed to be the bosses, the board of directors, they often care more about having a friendly buddy-buddy relationship than they do about providing tough oversight. And this lack of accountability, well, it opens the door for what one CEO famously called bold imaginative accounting. This is where executives basically give up on improving the business and instead focus all their energy on manipulating how people perceive the business. So the main weapon they use in this little game is something called the restructuring charge. Now, it sounds super official and legitimate, but in reality, Buffett warns it's often just a tool for deception. It lets a company take a whole bunch of unrelated costs and just dump them all into one bad quarter. They take what's called a big bath, which makes all the future quarters look artificially amazing by comparison. Buffett explains this with an absolutely brilliant golf analogy, so stick with me here. Imagine a golfer who wants everyone to think he's a pro. In his first round, he intentionally writes down a terrible score, like 140. He calls this restructuring his swing. Okay, then for the next 4 rounds, he only counts his good holes. What about the bad ones? Oh, he just charges those to that awful first score. So his scorecard reads 140, 80, 80, 80, 80. Wall Street looks at that, ignores the first number, and calls him a genius who consistently shoots an 80. When in reality, he's just an average Joe hiding all his mistakes. So you're probably thinking, okay, this sounds shady, but is it really a widespread problem? How big of a deal is this? Well, get this. In a single year, 1998, a preliminary count found that these so-called special charges taken by corporations added up to a mind-blowing $72.1 billion. And to really wrap your head around that number, just look at this chart. That $72.1 billion was more than 22%, almost a quarter, of the entire combined profits of the 500 largest companies in America from the year before. So yeah, this isn't some tiny little accounting quirk. It's a massive distortion of what's really going on in the economy. But here's what Buffett finds really crucial. These accounting games, they're usually just a symptom of a much deeper problem, a company completely losing its focus. And this is often driven by a toxic cocktail of executive ego, boredom, and that relentless pressure to meet Wall Street's expectations. Buffett warns that even the absolute best businesses can get sidetracked. And these are real examples. He points out that years ago, Coca-Cola, yet the soda company, got into the business of growing shrimp. And Gillette, the shaving company, was out there exploring for oil. It is a classic case of management getting bored with their amazing, profitable core business and just wandering off to chase something shiny and new. And a huge catalyst for this is the obsession with predicting earnings. You see, when a CEO gets out there and publicly promises, let's say, 15% growth every year, they're basically setting a trap for themselves. Because for a big company, that kind of sustained growth is incredibly rare. The pressure to hit that impossible number just becomes enormous. And that pressure, well, it sends them down a really dangerous, slippery slope. It starts with making bad business decisions just to make the numbers look good for the quarter. When that stops working, they move on to the imaginative accounting games we just talked about. And when those tricks run out, the final step can be outright fraud. You know, as Buffett says, more money has been stolen with the point of a pen than at the point of a gun. Now, this internal pressure to hit the numbers is matched by an equally powerful force on the outside, the psychological pull of the herd. This creates this bizarre situation where it's often safer for a CEO's career to be wrong with everybody else than to be right all by themselves. And this is one of Buffett's most memorable lines ever. The logic for a CEO is simple. If you make a smart but unconventional decision and it goes wrong, you're fired. But if you make a dumb but conventional decision that everyone else is making and it goes wrong, well, hey, you were just following the trend. No single lemming gets blamed when the whole group runs off the cliff together. Buffett tells this incredible story about a CEO friend who was trying to convince his board to approve a huge acquisition. After he totally failed to make a good economic case for it, he just looked at them and said, fellas, all the other kids have one." It's a joke, of course, but it perfectly captures the childish, peer pressure logic that can drive billion-dollar business deals. All right, so this brings us to our final section, the role of the so-called gatekeepers of the whole financial system. the investment bankers, and the ethical standard Buffett thinks they ought to be held to.
This is just such a powerful metaphor. Buffett argues that investment bankers have a moral duty to protect investors from bad deals, the same way a good bartender has a duty to cut someone off to stop them from driving drunk. The banker should be willing to say no to the profit from that next drink, that next bad deal, to keep from hurting the public. But as he notes, that particular high road on Wall Street hasn't seen a whole lot of traffic.
So after walking through this entire critique, we're left with a really crucial question to ask ourselves. And this isn't just theory. For every single company you invest in, every stock you own, you have to look at the evidence, their actions, their accounting, what they buy, and ask yourself, are they really treating me like a partner? Or am I just the patsy?
All right, let's get right into it. When you hear the name Warren Buffett, you probably think of just staggering, unbelievable success, right? But what if I told you the real key to his genius isn't in all his wins, but actually in his losses? See, today we're not going to study the triumphs. We're going to open up Buffett's own case files on his biggest blunders to really understand the powerful philosophy that was forged by all that failure. This is Chapter 15, Mistakes I've Made. And this quote right here, it really sets the entire stage. Buffett kicks things off with a statement that sounds simple but is actually pretty radical in the business world. He's saying, look, don't wallow in regret, but you absolutely cannot sweep your mistakes under the rug. He points out that most companies either pretend their dumb decisions never happen, or they try to twist them into looking like smart moves. Buffett's way? No way. He treats them like a surgeon treats a failed operation. You get in there, you do a rigorous postmortem, and you figure out exactly what went wrong.
So here's the game plan for our journey through Buffett's brain. We're going to start with his early cigar butt folly, then get into his lessons on people and problems, jockeys and dragons. Then we'll cover the invisible errors that cost him billions and the one he personally calls his worst deal ever. And finally, we'll see how all of this came together to create his legendary philosophy.
To put it simply, for Buffett, looking back at mistakes isn't about shame, it's all about preparation. As he puts it, it's a good idea to review your past mistakes before you go out and commit new ones. He really believes that these postmortems are just as useful for a business as they are for a hospital or even a football team. It's a tool for growth, not a reason to beat yourself up.
Okay, so let's get into his first and maybe the most fundamental strategic error he ever made. This is a concept that was the bedrock of his entire early career, and learning to let it go, well, that changed everything. He calls it the cigar butt approach.
So what on earth is a cigar butt investment? Well, imagine you're walking down the street and you find a discarded cigar. It's gross, it's soggy, but it's got just one good puff left in it. Now, it's not a quality smoke, but because you got it for free, that one last puff is pure profit. In business, that means buying a really struggling company just because its stock is dirt cheap. You're not looking for a great business for the long haul. You're just hoping to get one last quick puff of profit before the whole thing goes up in smoke.
And this, right here, perfectly illustrates the huge shift in his thinking. He learned the hard way that this cigar butt approach is a fool's game. Why? Because when you buy a lousy business, as soon as you solve one problem, another one pops up. As he says, there's never just one cockroach in the kitchen. But more importantly, he had a huge realization. Time is the friend of a wonderful business, but it's the absolute enemy of a mediocre one. So he completely flipped the script. He went from looking for a bargain price on a so-so company to being willing to pay a fair price for a truly excellent one.
You know, this whole idea of focusing on high-quality businesses leads directly to his next big set of lessons, all about people and problems. He learned to understand the limits of even the absolute best managers, and maybe more importantly, how to know which challenges are even worth taking on in the first place.
This quote is just brutally honest, isn't it? What Buffett learned is that even the best managers, the superstar jockeys, they can't win a race if they're riding a broken-down horse. A brilliant CEO simply cannot fix a business that has fundamentally terrible economics. In that fight, the bad business almost always wins, and its reputation for being a disaster will outlast the manager's reputation for being a genius.
So here's the really crucial takeaway. Buffett's success doesn't come from being some heroic problem solver. It comes from being a master of problem avoidance. He says that after decades in business, he and his partner Charlie Munger haven't learned how to solve difficult business problems, they've just learned how to avoid them. They focus on the easy, obvious opportunities, the one-foot hurdles they can just step over, because that's way more profitable than trying to be a hero and slay dragons.
Now, the mistakes we've talked about so far are what you'd call sins of commission, bad deals he actually went out and made. But Buffett says his most painful, most egregious errors often fall into a totally different category, the ones that are invisible, the ones that never, ever show up on an accounting statement but can be just devastatingly expensive.
Buffett says that probably the most surprising discovery of his long career was this unseen force that can make really smart, decent managers make completely irrational, crazy decisions. He has a name for it, the institutional imperative. It's this set of dynamics that just pushes organizations to behave in ways that defy all logic.
These are kind of like the four horsemen of the institutional imperative. First, organizations act like a train on a track. They just want to keep going in the same direction, even if that direction is straight off a cliff. Second, projects and acquisitions magically appear out of thin air just to use up whatever cash is lying around. Third, if a CEO has a really bad idea, it's rarely challenged. Instead, their staff will create entire studies to prove how brilliant it is. And finally, companies will just mindlessly copy what their competitors are doing, whether it makes a lick of sense or not.
This second type of invisible error, this one is maybe even more painful. These are the sins of omission. Now, Buffett isn't talking about missing some hot tech stock he didn't understand. Nope. He's talking about the huge, screamingly obvious opportunities that were served up on a silver platter that he totally understood, but then he just failed to act. He calls this his thumb sucking, and he readily admits the cost has been enormous.
And here is just a staggering example. Back in 1988, he decided to buy a huge chunk of Fannie Mae. He knew the business inside and out, he admired the CEO, and he saw its potential to be a financial powerhouse, so he bought some shares. And then the price went up a tiny bit, and for whatever reason he got frustrated and just stopped buying. Then, in a move that was even worse, he sold the shares he already owned. The cost of that inaction, of that thumb-sucking, about $1.4 billion in missed gains. Ouch!
But as costly as those omissions were, Buffett is crystal clear about the single worst deal he ever made. This wasn't a sin of inaction. This was an active choice that became a masterclass in how a really bad decision can be compounded into a total, unmitigated catastrophe. Let's talk about the Dexter shoe deal.
The very first mistake was just a fundamental misjudgment of the business. In 1993, Buffett bought Dexter's shoe because he thought it had what he loves to call a durable competitive advantage, basically a strong moat around the castle that would protect it for years. Well, he was dead wrong. That advantage was about to be completely obliterated by low-cost foreign competition. The moat he thought he saw was just a mirage.
So he paid $433 million for this business. Now that's a huge error all by itself, buying a company right before its entire business model collapses. But believe it or not, that wasn't even the biggest mistake. The real disaster was how he paid for it.
And this is the crucial detail that turned a really big mistake into a legendary one. Instead of paying with cash, Buffett paid with Berkshire Hathaway stock. He essentially traded away a small piece of his incredible collection of wonderful businesses like Coca-Cola and American Express for a business that would soon be completely worthless. It just makes no sense.
Because he used his own stock, the true cost wasn't that $433 million price tag. Oh no. The true cost was the value of what those Berkshire shares would become over time. By his own math, that compounded error cost his shareholders a jaw-dropping $3.5 billion. He didn't just buy a worthless business, he gave away a fortune to do it.
Buffett sums up the painful lesson of deals like Dexter with this perfectly witty, self-deprecating line from a country song. It just perfectly captures that feeling when the initial excitement of a deal wears off and you're left facing the cold, hard, ugly reality of what you've actually bought.
So after walking through all of these colossal errors, what's the big takeaway? Well, all these painful lessons, from the cigar butts all the way to Dexter's shoe, they weren't just wasted money. They were the raw material that Buffett used to forge his core principles for business, for investing, and really, for life.
And this slide really summarizes that hard-won wisdom. First, he learned to only go into business with people you genuinely like, trust, and admire, because as he says, they've never succeeded in making a good deal with a bad person. He also learned to never, ever risk something you have and need for something you don't have and don't need. And finally, that a small chance of disgrace can't be justified by a large chance of extra returns. These are the principles of prudence, all forged in the fire of failure.
Years later, after all the decades of incredible success and painful failure, the journalist Charlie Rose asked him a very direct question, really the one we've been exploring this whole time.
He just asked him straight up, "What was the single dumbest mistake you ever made?"
And his answer is just the ultimate lesson, isn't it? It's an incredible display of humility and forward-looking wisdom. He isn't defined by his past errors. He knows the potential for making a mistake is always there, and that the process of learning is never, ever finished. For Warren Buffett, the most important mistake is always the next one, and the most important lesson is just staying humble enough to learn from it when it comes.
Welcome to The Explainer. Today, we're going to unpack the timeless wisdom of Warren Buffett, one of the greatest investors on the planet, to see what his philosophy can teach us about personal investing. Okay, let's start right here with this quote, because honestly, it's the key to everything we're about to talk about. It's this wild paradox. The ideas behind smart investing are actually pretty simple. The hard part, the part that isn't easy at all, is having the emotional discipline to stick with them. So before we even get into the weeds, let's get one thing straight. Buffett is really clear about this. For most of us, the best thing to do is just buy a low-cost index fund and call it a day. He's convinced that one simple move will get you better results than most of the high-flying investment pros, especially after you subtract their fees. But, and this is a big but, if you're the kind of person who really wants to build your own portfolio, well then what he offers is basically a masterclass in how to think about investing. And it's not about being a genius who knows everything about every company. Nope. It's about knowing a few businesses really well, what he famously calls your circle of competence. So where do you even start? Well, it all begins with the right education. And you might be surprised to hear that according to Buffett, the curriculum is, well, it's pretty darn short. First lesson, you might need to forget what you've been taught. All that complicated stuff from business school, beta, option pricing, modern portfolio theory, Buffett thinks it's mostly noise. In fact, he says it can actually do more harm than good. You might be better off just not knowing it at all. So what do you need to learn? It all boils down to just two things. That's it, 2 courses. Number 1, how to figure out what a business is actually worth. And number 2, how to think about the market's crazy price swings and see them as an opportunity instead of, a reason to panic. And this right here, this is the absolute core of his philosophy. You have to get this in your head. You're not just buying a stock, a little ticker symbol blinking on a screen. No, you are buying a piece of an actual real-life business. And before you do, it has to pass these 4 simple common sense tests. This quote just says it all, doesn't it? It's all about playing the long game. If you can't picture yourself happily owning this company a decade from now, then just walk away. The whole idea is to find great companies and let their success become your success over time. We're talking about ownership, not a short-term fling. Okay, moving on. Let's see how this way of thinking completely changes how you should look at risk and price. And to do that, we're going to use one of the best stories in the entire world of investing. You have got to understand this difference. In the academic world, they define risk with a term called beta, which is just a fancy way of measuring how much a stock's price jumps around. So by that logic, if a stock price falls, it's suddenly riskier. Buffett thinks that's totally absurd. For him, risk is simple. It's the chance that you will permanently lose your money. So when the price of a great business goes down, that's not more risk, that's less risk. It's an opportunity. To really nail this idea down, Buffett's mentor, Ben Graham, invented this amazing character, Mr. Market. Imagine he's your business partner, but he's completely manic depressive. One day, he's euphoric, offering you a crazy high price for your shares. The next day, he's in a total panic, convinced the world is ending, and begging you to buy his shares for pennies on the dollar. And here's the beautiful part. You don't have to listen to him. You are totally free to ignore his wild mood swings. But when he gets really pessimistic and offers you a wonderful business for a silly, low price, that's when you act. You take advantage of his foolishness. The intelligent investor doesn't just tolerate volatility, they welcome it. All right, so we've got the mindset. But what about the actual tool for figuring out what a business is worth? Well, forget about complex algorithms. The formula we need has been around for over 2,600 years. Yep, that's it. This old saying from Aesop. Buffett says this is the bedrock of all investing valuation. It applies to anything that produces cash, whether it's a stock, a bond, or a farm. He says it's a fundamental truth that was true in ancient Greece and it'll be true 100 years from now. So how do we turn this fable into a practical tool? It's pretty straightforward. You just have to answer 3 questions about those birds in the bush, which for us are just future cash flows. 1, how sure are we that there really are birds or dollars in that bush? 2, when are they going to come out and how many will there be? And 3, what's the interest rate we could get on something totally safe, like a government bond?
Now, this is a super important distinction to make. All those metrics you hear thrown around, PE ratios, dividend yields, you name it, they aren't valuation in themselves. They're not the answer. They're just little clues that might, and I mean might, help you answer those 3 big questions about the birds in the bush. That's all they're good for.
Okay, I get it. This all sounds good in theory. But does it actually work in the real world? And what happens when people ignore this stuff and just follow the herd? Let's kick things off with a little thought experiment. I want you to picture this. The entire population of the United States decides to enter a giant national coin flipping contest. Everybody starts with $1. Every day you flip a coin against someone else. The winner takes the loser's dollar and moves on to the next round. If you keep this going for 20 days, you'd be left with about 215 people. And through pure random luck, each one of them would have turned their single dollar into over $1 million. Now, what do you think they'd be doing? They'd be on talk shows, writing books about their coin-flipping technique, but we'd know it was just dumb luck. But what if you looked at all those winners and realized that, say, 40 of them all came from the same tiny town? You'd get suspicious, right? You'd think, something's going on in that town. Well, Buffett says that's exactly what happened in investing. A huge number of the all-time greats all came from one intellectual village. They all learned from the same guy, Ben Graham. That's not a coincidence. That's not luck. It's a method that works. Now, let's look at the flip side, speculation. Buffett warns that speculation is most dangerous when it looks the most appealing, when it seems like everyone around you is making effortless money. That's the moment when even the most sensible people can lose their minds. He calls this the Cinderella at the ball problem. In a speculative bubble, everyone kind of knows the party has to end at midnight, that everything's going to turn back into pumpkins and mice. But they're having so much fun, they think, I'll just stay for one more song. I can get out at 11:59. Here's the catch. In a bubble, the clocks have no hands. You have no idea when midnight will strike. And that brings us to our final section, which is maybe the most important piece of this whole puzzle. It turns out that being a successful investor isn't about having a stratospheric IQ. It's all about having the right temperament. Buffett absolutely loves using this analogy about the baseball legend Ted Williams. Williams, one of the greatest hitters of all time, actually mapped out the strike zone into 77 different squares. He knew that if he only swung at pitches right in his perfect sweet spot, he'd bat 400. The key to his success was the incredible discipline to just wait for that perfect pitch. And here's the best part. In investing, unlike in baseball, there are no called strikes. Just think about that for a second. The market can throw you thousands of pitches, crazy ideas, hot stocks, tips from your friends, and you don't have to swing at a single one. There's no penalty. You can just stand there and wait and wait and wait for that one perfect pitch right in your wheelhouse. Ultimately, everything we've talked about comes together in his most famous saying: the emotions of fear and greed are never, ever going away. They are a permanent feature of the investment world. Your job isn't to predict them. Your job is to have the emotional stability to be fearful when everyone else is greedy, and to be greedy only when everyone else is fearful. So when all is said and done, it's not about some complex secret formula. It's about simple, but incredibly difficult discipline. In a world that is just screaming for your attention 24/7, the real question is, do you have what it takes to ignore the noise, resist the urge to follow the crowd, and just patiently wait for your perfect pitch? That's the challenge.
You know, when you hear the name Warren Buffett, your mind immediately goes to billions of dollars, Berkshire Hathaway, maybe some brilliant stock picks. But there's this whole other side to him, a side he actually thinks is way more important. Buffett, the teacher. So in this explainer, we're not going to talk about stocks at all. Instead, we are opening up his playbook on the lessons he says are the most valuable. Not about how to get rich, but about how to build a life of character, of fulfillment, and, well, what he calls true success.
In this quote right here, it just sets the stage perfectly, doesn't it? It's a direct shot at that whole idea of, I'll just grind it out now, suffer through it, and be happy later. For Buffett, that's just a terrible bet. A life worth living starts today, right now.
Which, it brings up a really interesting question. Why on earth would one of the richest, busiest people on the planet consistently say no to big money speaking gigs for CEOs and powerful execs, but almost always say yes to a room full of college kids? What's in it for him?
Well, it's because he thinks young people are still open. Their minds aren't set yet. He's not there to get a round of applause. He's there because he genuinely believes that a few key ideas, if they land at just the right time, can completely change the direction of a person's life for the better. He's not investing in companies, he's investing in people. It's the ultimate long-term play.
So what are these life-changing lessons? All right, let's take a look at the syllabus for our little masterclass with Professor Buffett. We're going to walk through his 5 core principles for living a life that's not just successful, but truly fulfilling.
First up, we've got the absolute foundation of his entire philosophy. Before you even think about putting a single dollar into a stock or a bond, Buffett says you have to invest in the single most powerful, most important asset you will ever own. And to explain this, he uses this just brilliant analogy. So picture this. You're 16 years old, and a genie pops up and says you can have any car in the world you want, it's yours. There's just one tiny catch. It's the only car you will ever get for the rest of your life. So how would you treat that car?
I mean, you'd treat it like it's priceless, right? You'd read that owner's manual cover to cover. You'd keep it in the garage, away from the rain and snow. You'd probably change the oil way more often than you need to. You'd fix every little ding and fight every tiny speck of rust the second you saw it, because this thing has to last a lifetime.
And boom, there it is. That's his point. That car, that's your mind and your body. You only get one of each, and how you take care of them right now is going to decide how well they run for decades to come. The best investment you will ever make is always in yourself.
And listen, Buffett absolutely practiced what he preached here. He was terrified, literally physically sick to his stomach at the thought of public speaking. He knew he had to fix it, so he signed up for a Dale Carnegie course, got scared, and actually stopped the check. But then he knew he had to face it, so he went back and paid the $100 fee in cash to force himself to go. He says the diploma he got from that course is the most important one hanging on his office wall, because learning to communicate gave him a huge edge in life. That is investing in yourself.
Now, this idea of looking after your own well-being, it flows right into his career advice, and it pretty much goes against everything we're normally told about paying your dues and climbing the ladder.
And, well, leave it to Buffett to put it so bluntly. He says taking a job you hate because you think it'll look good on your resume is nuts. It's like putting off all the joy in your life for some future that might not even come. It's just a terrible strategy.
So his advice is actually pretty simple. Don't chase the highest salary. Chase what you're passionate about. Go work for people you admire. Go work for a company you admire. When he finally got the chance to work for his hero, Ben Graham, he didn't even ask what the salary was. He just knew he had to be there. The fulfillment, he says, comes from the work itself.
But, and this is a really important piece of the puzzle, from his partner, Charlie Munger, passion isn't quite enough by itself. It has to be connected to something you're actually good at. You've got to find that sweet spot, that intersection between what you love to do and what you have a natural talent for. That's where real success happens.
Okay, so this next part, this is really the emotional core of Buffett's teachings. It's this powerful little thought experiment that he gives to students that just cuts right through all the noise of grades and resumes and gets to what really matters in the long run.
So he tells the students, look around the room, I'm going to give you a chance to buy 10% of the future earnings of any one of your classmates for the rest of their life. Who do you pick? Who are you going to bet on? And you can't pick the person with the richest dad. It has to be based on them as a person.
You probably wouldn't pick the person with the highest IQ or the best grades. You'd pick the person that people just like to be around. The one who's a natural leader, who's generous, who's honest, who gives credit to other people. And then he flips it. He says you also have to short one classmate, bet against them. Who do you pick then? The person who's arrogant, a little greedy, who cuts corners? It's not about brains. It all comes down to character.
And here is the punchline. This is the whole point. All those good qualities on the buy list, none of them are rocket science. They're just habits, and you can decide right now, today, to start practicing those habits yourself. But this quote is a serious warning. You have to start now, because those habits, good or bad, get locked in over time until they're almost impossible to change.
So, okay, you're working on building these good habits. That's great. But how do you actually apply them when you're in a tough spot and have to make a hard choice? Well, for that, Buffett has a test that is just brilliantly simple.
He calls it the newspaper test. It's simple. Before you do something, just ask yourself this. Would I be okay with this action being written up by a smart but not so friendly reporter on the front page of my hometown newspaper? You know, for all your friends and family to read. He says if you even hesitate for a second, just don't do it.
And you can see how this all ties together, right? This simple ethical test leads directly to his ultimate definition of success and has nothing to do with the size of your bank account. He says, at the end of the day, the only thing that really matters is if you've earned the love and respect of the people you care about. That's the one thing money can't buy, and without it, you failed. Which leads us to the final, and I think the most powerful lesson of them all. All of these different ideas, investing in yourself, finding your passion, building good habits, they all come together under one big, empowering idea: personal ownership.
The key takeaway is this: your character isn't set in stone. The person you are today does not have to be the person you are tomorrow. You have the power, through your daily choices and the habits you build, to literally shape yourself into the kind of person you actually want to be.
And that's really the beauty of it all. You are your own greatest asset. You own 100% of the stock in You Incorporated. You have total control, and guess what? You're stuck with it for life. So you might as well get to work making that asset as valuable as it can possibly be.
In the end, Buffett's greatest lesson isn't really about how to get rich, it's about how to live a rich life. All of his wisdom is a reminder that the most important decisions we'll ever make aren't about what we buy or what we invest in. They're about who we choose to become.
Welcome, sometimes the biggest lessons about business, finance, and just life, they don't come from some thick, dusty textbook. Nope. They come from these simple, funny stories that just kind of stick in your brain. So today, we're going to dive into a bunch of anecdotes that use humor to get at some really timeless truths.
Okay, let's just jump right in with a classic from Warren Buffett. This one really sets the stage perfectly. It's funny, for sure, but it's also this incredible commentary on the laser-focused priorities you see in high finance. Now, in case you're wondering, repricing options is basically a do-over for executives. If the company's stock tanks, they can just reset the price of their stock options so they're valuable again. So in this joke, faced with the ultimate temptation, what's the CEO's deepest desire? A financial reset. It tells you everything you need to know about what's really on some people's minds.
And that joke leads us perfectly into our first big theme, the follies of finance. This is where we're going to see how humor can be like a spotlight, It shines a light on the bizarre, often upside-down logic that can take hold in the world of money.
I mean, you gotta love the sharp, cynical honesty in this quote from John Stump, the former CEO of Wells Fargo. It just cuts right through the noise, doesn't it? The whole idea that financial innovation isn't always about progress. A lot of the time, it's just about finding more complex, more creative ways to make the same old mistakes.
But here's the thing. These follies don't just happen on a spreadsheet. They start with people. They start with very human motivations, or, as you'll see in this next story, a pretty shocking lack of motivation. So let's look at this tale of a tycoon who thought all his prayers were answered the day his daughter got married.
So picture this, the tycoon is just over the moon. He finally has the son he always wanted. And in this huge, welcoming gesture, he doesn't just offer the kid a job. No, he makes him an equal partner, right from day one. He literally hands him a stock certificate for half the entire company. I mean, you can't get a more generous welcome than that, right?
So the father-in-law makes a logical first move. He offers him a key role in sales, the lifeblood of any business. But the son-in-law's reply is instant. He basically says, nope, I'm completely useless at that. He just shuts down a core part of the business right away.
Okay, the tycoon doesn't miss a beat. He pivots. All right, no sales? How about human relations? The rejection this time is just as fast and, honestly, even more blunt. The son-in-law doesn't just sound unqualified, he seems to actively dislike every single basic component of running a business. And then, finally, after he's turned down every offer of actual work, the son-in-law shows his hand. He doesn't want to do a thing, he just wants the cash. It's a hilarious but also a really sharp little parable about a certain kind of ambition, isn't it? The ambition for the reward with absolutely zero interest in the effort.
So that story was about a liability in human form. But what about the financial liabilities that just refuse to go away? This next one is a darkly funny look at those hidden recurring costs, the kind that can totally blindside you long after you thought you'd paid the bill and closed the books.
Okay, so the story goes like this. A guy pays thousands of dollars for his father's funeral. He thinks, okay, that's done, it's settled. But then a bill for $10 shows up. The next month, another one. He's totally confused, so he asks his mom what's going on. And her reply? Well, it reveals this absurd truth. It's just a perfect, if a little morbid, metaphor for those financial deals where you never actually own the asset and you're stuck with these little hidden costs forever and ever. You know, these financial follies, they often come from something a lot deeper. And that brings us right to our next theme, this huge gap that can exist between how we see ourselves and, well, who we really are. This section is all about ego, self-perception, and the powerful tricks our own minds can play on us. So, let me give you a really charming example of this. We've got a 4-year-old girl named Emily. It's her birthday party, and she's helping a magician with his tricks. He gives her a magic wand and tells her to wave it at a box. So she waves the wand, and boom, green handkerchiefs turn blue. She waves it again, and loose ones suddenly become knotted together. And after a few of these, Emily is absolutely 100% convinced that she has magical powers. It's a cute story, right? But it is such a powerful lesson for investors, for CEOs, for all of us. It's so easy to think you're a genius when you're just in the middle of a bull market.
And this whole question of self-awareness is just perfectly captured in the way two famous business partners, Warren Buffett and Charlie Munger, looked at owning a private jet. On one side, you've got the legendary frugal Munger. For him, luxury travel is an air-conditioned bus, and only if he got a good deal on the ticket. And on the other side, you have Buffett, who hilariously admits how indulgent the jet is. He compares his desire for it to a famous prayer, "Lord, make me chaste, but not yet."
The story of naming the jet is a whole thing in itself. Buffett cheekily suggested naming it the Charles T. Munger after his frugal partner. Munger, with his classic dry wit, shot back that it should be called the aberration. So what did they settle on? The perfect compromise. The indefensible. It's a name that just wears its own absurdity right on its sleeve.
So these stories about ego and personal quirks, they're not just about individuals. They actually zoom out to reveal bigger truths about human nature itself. And that brings us to our next section, a little guide to human nature, where we'll look at what we really prioritize and why. All right, check out this super simple story. It takes place in a grocery store. You've got an elderly man and a young man, and they've both lost their wives somewhere in the aisles. So they decide to team up, to cover more ground. The older man asks the younger one to describe his wife, so they know who to look for. And the description he gets is, well, let's just say it's vivid. He paints this picture of an absolute bombshell, a description designed to be, shall we say, highly motivating. And there it is, the punchline. The second the older man hears this incredible description, he completely abandons the search for his own wife. In one hilarious, perfect line, his priorities do a complete 180. It's just a raw, funny, and unforgettable look at how quickly self-interest can steer the ship. This brilliant cartoon kind of captures the same idea, this disconnect between what we expect and what's really going on. The whole world is hanging on an investment guru's every word, hoping for some secret stock tip whispered from on high. But the reality of our own inner lives, our dreams, is often, well, a lot more mundane and a lot more personal.
And all of this, all these stories, brings us to our final and honestly maybe our most important point. It's about the fundamental, rock-solid difference between what we call something and what that something actually is. It's all about seeing reality clearly.
And to hammer this point home, let's turn to one of Abraham Lincoln's favorite riddles. It's a question that every manager, every accountant, every leader should probably ask themselves on a regular basis. The question is simple. How many legs does a dog have if you call its tail a leg?
The answer, of course, is 4.
And why 4? Because, as Lincoln would point out, calling a tail a leg doesn't make it a leg. And that is the whole lesson, right there. It's so profound. You can use any fancy language you want, you can slap any creative label on something, but you can't change what it fundamentally is. A tail is a tail, debt is debt, and a loss is a loss, no matter what you decide to call it in the annual report. So let's wrap this all up with this wonderfully pragmatic thought from the great comedian Jack Benny. It's just a perfect summary for everything we've talked about. Life is going to throw all sorts of absurd things at you. The good stuff and the bad stuff. The things you feel you've earned and the things you definitely haven't. And maybe the wisest thing you can do is just accept it all with a little bit of grace and, most importantly, a sense of humor.